Okay, let's proceed with our corporate tax journey. Today we will we'll touch on the Income Tax Act 1947, trading tax computation, the format of trading tax computation, the basis period, the tax rate for companies, as well as the general charging principles, what are taxable, what are not taxable, income versus capital receipts, charging sections, badges of trade. And we will have a short break. Thereafter, we will touch on the general deduction principles, the general deduction formula, specific deductions, as well as prohibited deductions. Okay, 1947 Income Tax Act. We will make reference to the Income Tax Act for the purpose of the tax computation. This Income Tax Act is 1947. Previously, the Income Tax Act is CAT 134. So with the revision in 2021, 31st December 2021, we are using Income Tax Act 1947. Okay. Okay, what's the tax computation? It's actually a statement showing the tax adjustments to the net profit before tax to arrive at the chargeable income. So the tax adjustments include non-taxable receipts, non-deductible expenses, further deductions, and capital allowances. This tax computation must be prepared in accordance to the provisions of the Income Tax Act 1947. Okay, this is a typical profit and loss account. We do have revenue, expenses, less the expenses to arrive at the net profit for the year. This is net profit before tax. So within the revenue items that are taxable and non-taxable receipts, and within the expenses, there are deductible and non-deductible expenses. So in order to compute the chargeable income, we need to remove the non-taxable receipts as well as the non-deductible expenses from the P&L. Okay. Okay, this is an overview of the trading tax computation. Note that in the trading tax computation, we will start off the first line as the net profit before tax. So like I shared earlier, the profit and loss includes all the revenue items, be it taxable and non-taxable receipts, as well as expenses that is deductible and non-deductible. So we will start off with the net profit before tax, and we need to exclude those non-taxable income and non-deductible expenses. We will also exclude the investment income and any expenses that is applicable to the investment income. Then we will less off the further deduction of expenses and revenue items capitalized to arrive at the adjusted profit. So after all this adjustment, the adjusted profit is actually the taxable profit, trading profits, that is subject to tax. Okay, so it excludes all the investment income and expenses, right? After the adjusted profit, we'll less the capital allowances, and we will add back the taxable investment income that we have previously excluded after the adjusted profit to arrive at the statutory income. Thereafter, we will have donations. We'll less off the donations to approve IPC to arrive at the chargeable income. Okay. Under the trading company tax computation, just now we show the overview. I provide you with a more detailed level of the tax computation. So we have again, always start with the net profit before taxation per the accounts. We will less off the investment incomes, like from separate source, those that are not trading source income, as well as those that are not taxable income, like exempt income, to arrive at the to to arrive at the amount that is taxable, the taxable profits. Okay, and also besides the taxable profit, we also have to add back the disallowable expenses. Remember, just now I mentioned that in the profit and loss account, we do have deductible as well as non-deductible expenses. So we do need to add back the disallowable expenses, as well as any direct expenses that is applicable to the separate source. So for the separate source income, we have already excluded. So now we are going to exclude the direct expenses applicable to the separate source income as well. We also have to deduct further deduction. So what is this further deduction? They could be expenses that is already included in the profit and loss account, and the provisions in the Income Tax Act 1947 actually allows further deduction of these expenses. So for example, renovation and refurbishment expenses and research and development expenses. Okay. Then we have these revenue items that is capitalized. We have revenue expenses that is not in the profit and loss account, but it is capitalized in the balance sheet. So for these items, since they are revenue expenses, we will also want to less them out to arrive at the adjusted profit before capital allowance. So for these Saturday sessions, we will be covering what are the taxable and what taxable receipts and what are the deductible expenses to arrive at the to arrive at the adjusted profits. Thereafter, in the next Saturday session, we will be talking about capital allowances. What are included in the capital allowances, like plant and machineries. And when you sell off the capital allowance, we do have to compute the balancing charge or balancing allowances. We also have what happens if the company is making losses and how do we treat these losses. Okay, so after that, we have less out all the capital allowance and the losses. We will add back the separate source income. So remember, just now we have less out the separate source income. Now we're going to add back the taxable portion of the separate source income. To arrive at the statutory income, thereafter we will less out the donations and the group relief, loss carryback, to arrive at the chargeable income before exempt amount. And for the year assessment 2023, we will have the exempt amount of 102,500 to arrive at the chargeable income after exempt amount. And this exempt amount will be taxed at 17%. And thereafter, we will less off any foreign tax credit. That means those foreign source income that has been subject to tax in the other countries and subject to tax in Singapore here. So they are also known as a double taxation relief, and to arrive at the net tax payable. Okay. Okay, this is let's do an example for the trading company tax computation. So for this company ABC income for the year ended 30th June 2022 is as below. We have a net trade income that including the disallowable expenses of 20,000. So the 180,000 net trade income actually includes the disallowable expenses of 20,000. And we have the other sources of income, like the Singapore one-tier dividend income, a gross amount of $1,000, as well as we less out the direct expenses attributable to the separate source income of $200 to arrive at $800, and a rental income of 50,000. So we have three classes of income here. We need to compute the tax liability for company ABC for the year assessment 2023. So this is a tax comp for company ABC for year assessment 2023. We have a net trade income of 180,000, and because it is net of the disallowable expenses, we will add back the disallowable expenses to be 20,000, and the adjusted profit will arrive at 200,000. Okay, we will then look at the taxable, any taxable separate source income. So for the Singapore one-tier dividend gross income is 1,000. we less out the allowable expenses to the Singapore one-tier dividend income, that is 800. But because Singapore one-tier dividend is an exempt income, so we are not bringing the 800 to tax. Okay. Then we have the rental income of 50,000, and we have a total chargeable income before exempt amount of 250,000. Then we'll less off the exempt amount. The exempt amount is for the year assessment 2023 is for the first 10,000, we will deduct 75% off, so we come up with 7,500, and the next 190,000 at 50% off, it will be 95,000. So the total exempt amount is 102,500. Okay, so if let's say a company that has a chargeable income before exempt amount of more than 200,000, they will usually have a full amount, exempt amount of 102,500. Okay, and chargeable income, and after we less off the exempt amount, we will have a chargeable income after exempt amount of 147,500, and we apply a 17% tax rate to arrive at $25,075. Okay. In tax payable, we will usually round to the nearest 2 decimal place, that means to the nearest cent. All right. The rest of the amount at the chargeable income level will be round to the nearest dollar. Okay, it will be at the nearest dollar, and the tax payable amount will be at the nearest cent. Do you have any questions? Okay, if no questions, I will move on. Okay, we do have some supplementary slides on the tax exemption for new startup company. So for startup company, they have another amount instead of $102,500. They have another amount, and for the investment holding company, notes is also for your reading. So the tax exempt amount for new startup companies that say they have a default that is first 100,000 at 75% would be 75,000, and the next 100,000 at 50% would be 50,000, and the total tax exempt is 125,000 as compared to 102,500 for these normal companies. Okay, so startup companies is only applicable for the first 3 years, first 3 years of assessment. Thereafter, from the 4th year assessment, the company will enjoy the partial tax exemption of 102,500 if they have a chargeable income of more than 200,000. Then we have the investment income. So investment holding company. So investment holding company is a company that does not carry on a trade or business and only derive passive source income such as dividend, interest, rental, and this because they do not carry on the trade, they are not. This company are not allowable for deductions like losses, CA claim, or losses carry forward. Okay, and also that expenses is also more restrictive to statutory expenses, direct expenses, and a portion of the indirect expenses. So these slides are actually quite self-explanatory. So we move on to slide 25. Okay. Okay, we have this basic period and tax rate for companies. Okay, when we are doing our tax computation, we always compute on a period basis. And which period should we be looking at? We will look at the basis period, right? So Singapore adopts a preceding year basis to tax all sources of income. So the basis period actually means that the period of profit on which tax for the year of assessment is assessed. And the year assessment is actually YA in short. refers to the year in which income tax is calculated and charged. So if Singapore adopts a preceding year basis to tax all sources of income, for individual, it will be a preceding calendar year. So starting from 1st January to 31st December of the preceding year. And for companies, it will be accounting period ending on any date in the preceding year. So if let's say the profits for the accounting year ended 30th September 2022, it will be assessed in year assessment 2023. Okay, so to make it simpler, accounting year ending the last day of the accounting year plus 1 year, it will be the year assessment. Okay, so it does not need to be a calendar year, it will be the accounting period. Unlike the individual that is on the calendar year from 1st January to 31st December, we'll look at the accounting period of the company's accounts, right? So for more pictorial view, for individual, we have 1st January to 31st December for 2021 and 1st January to 31st December for 2022. So for the year assessment 2022, the individual basis period will be from 1st January to 31st December 2021. And for YA 2023, an individual will be assessed from the basis period 1st January 2022 to 31st December 2022. And for companies, we will be looking at the last day of the accounting period. So if the last day of accounting period falls within 1st January to 31st December 2021, it will be assessed in year assessment 2022. Okay, so now we look at the following year. It will be fall within the 1st January 2022 to 31st December 2022. So we add one more year, the year assessment is year assessment 2023. Okay. So let's take a short quiz to test your understanding on the basis period. What is the applicable YA for the company with a financial year ending 31st March 2021 as well as a financial year ending 31st December 2022? Okay, I shall end the poll now. So for the company with a financial year ending 31st March 2021, the year assessment will be YA 2022. So it's looking at the financial year ending plus one more year, it will be YA 2022. So for the financial year ending 31st December 2022, we will look at the financial year end, and at one more year, it will be YA 2023. Okay, most of you have got it right. So for tax rate and partial tax exemption, for year assessment, which you will be tested is YA 2023. The tax rate is 17% and the partial tax exemption is 75% of the first 10,000, which is 7,500, and the 50% on the next 190,000, that will be 95,000. Altogether, you'll come up to be 102,500. So a company is taxed on a flat rate of 70%, regardless whether it is a local or foreign company. And this partial tax exemption will be given to companies who are residents in Singapore or non-residents in Singapore on normal chargeable income. So if income that is not the normal chargeable income that is taxed at another rate, they will not be applicable for this chargeable partial tax exemption. Okay, so far so good, right? Okay, next we will touch on the general charging principle and what is essentially what is taxable receipts, right? Okay, so for income versus capital receipts. For Singapore, we have no capital gains tax. We only subject income to tax, so we need to distinguish between the income versus capital receipts. And there is no definition in the Income Tax Act 1947 to define what is income and what is capital receipts. And for that, we will need to draw the principles from the case law to distinguish whether a receipt is actually an income or a capital in nature. So a receipt that is of income nature will be subject to tax and is under the chargeable, the income that is chargeable to tax. And for capital receipts, they are not subject to tax. So what if, let's say, the receipts is included in the profit and loss account? We always look at the profit and loss account because our tax computation only starts on the first line is always the net profit before tax. So if let's say these receipts has been included in the profit and loss account and it is of income nature, we will not make any adjustment, right? If it is of the capital receipts nature, we will have to exclude it, all right? So remember, income nature receipts will always be taxable. Capital receipts is not taxable in Singapore. And to distinguish whether they are capital or revenue receipts, we can apply two tests. One test is called the permanent structure of the businesses, and the other test is fixed or circulating capital. Okay, for the permanent structure test, we will look whether the assets form part of the permanent structure of the business and whereby means where the profit are earned. And for, let's say, the receipts is of a revenue nature, we'll look at whether it is subject to the method of trade, for example, trading stocks, okay, as compared to capital in nature, maybe fixed assets that is used in the businesses to earn profits, all right? And again, these are the case law that we have drawn for the guiding principles to determine whether it's capital or revenue receipts for the permanent structure test, revenue or capital receipts here. Okay, so let's do a quiz to test your understanding on capital versus revenue receipts. Okay, capital receipts is not taxable, revenue receipts are taxable. Okay, you have signed a contract for a franchise in Singapore. Subsequently, the contract was terminated and you were compensated with a sum of money. So let's see whether is this capital or revenue in nature. Is the compensation money or revenue or capital in nature? Okay, I will share the results.
Are you going to shower first or am I going to shower first?
Okay, so whether this contract is capital or revenue nature, we always look back to the nature of business. If let's say the nature of business for this franchise that they have signed is relating to the permanent structure of the company, and it is not just one ordinary trading contracts, then it will be considered as capital in nature. So for franchise contract, usually we will regard it as capital in nature because if let's say that is the only franchise contract for the business to carry on. Okay. The other test we will also look at whether it is a fixed or circulating capital. Okay, so for a fixed capital is actually what you use to turn to profits, and circulating capital is by parking this capital and letting the change master. So essentially, I would say that fixed capital is something like fixed assets, and circulating capital will be looking at your stocks and trade.
Sorry, Rebecca, I think your voice becoming a bit soft.
Oh, now
Yeah.
can you hear?
Yeah, okay.
Okay, thanks for letting me know. So for the second test, whether it is a fixed or circulating capital, fixed will be more likely to be assets fixed capital that is retained in the business with the object of producing profit. So more likely to be like fixed assets versus circulating capital and assets that will be part of the circulating capital if it's acquired in ordinary course of trade that is sold or used in the manufacturing of what is sold. Okay, so whether an asset is circulating or fixed capital, again, it depends on the facts of the case of and circumstances of each case. So we always look at the assets in relation to the business, right? So for example, a trader is in a business of buying and selling cars. The cars will form the circulating capital. On the other hand, where a motor car is owned by a taxi driver and it is used as a taxi, then the taxi will be formed as its fixed capital. Okay, so we always look at the capital in relation to the businesses. A building is constructed by a manufacturer for use in its trade will be a fixed asset. And on the other hand, the building that is constructed by a property developer for sale, it will be a stock in trade. So that will be considered as circulating capital. Okay, let's do a poll to test the understanding on fixed or circulating capital. You are in the business of buying and selling used laptop. You keep a laptop to generate invoices and to record purchases and sales. So is this laptop that you use to generate invoices and record purchases and sales considered a fixed or circulating capital? Yeah, end the poll now. I share the results. So for the particular laptop that is used to record, generate invoices and record purchases and sales, they are actually fixed capital. Since the company is in a business of buying and selling laptops, so laptops should actually be the company circulating capital, right? But just look at the nature of this laptop. This particular laptop is actually used for the company businesses. It's not actually meant for buying and selling. So we will not consider this laptop as a stock. We will consider it as an asset for the company to record the sales and purchases. Okay. Also, to determine whether the receipt is an income or capital receipts, we will take guidance from the Whiteman Income Tax, which lists the following 5 basic propositions. Payment for the sale of assets used in the business to generate income is regarded as capital receipt, is not taxable. So the payment received for the destruction of profit-making apparatus, like the franchise, if that's the only franchise agreement, then it is regarded as capital receipt and it is not taxable as well. Payments in lieu of trading receipts, such as insurance money received for the loss of trading stock destroyed by fire, it will be regarded as revenue receipts, which is taxable. And payment made in return for substantial restriction of one activities like restrictive covenant is regarded as capital receipt, is not taxable. And payment of recurring nature is regarded as revenue receipt and it is taxable. Okay. Okay, now we look at the Income Tax Act 1947. So under what section is the income chargeable to tax? So we will look at section 10 of the Income Tax Act, which is the charging section. And income falling within the charging section is subject to tax. So those income that is under section 10 will be subject to tax unless it is exempt under section 13 of the Income Tax Act. So let's look at what is the income that is under section 10.1. Okay, section 10.1, sources of income. We have section 10.1a, that is the gains or profits from trade, business, profession, or vocations. Examples of this person whose income is taxable under these categories are companies, sole proprietor, partners, lawyers, brokers, real estate agents, insurance agent, hawkers. Okay, then we have gains from employment. This is actually the employment income like salary, leave pay, fee, commission, and bonuses. Okay, then we have section 10.1d, which includes dividend, interest, and discount. So dividend is actually paid by Singapore tax resident company. It's exempt in the hands of shareholder. Note that dividends are subject to tax under section 10.1 unless it is specifically exempted under section 13. So dividend paid by Singapore tax resident company is exempt in the tax of the shareholder. So for shareholder who receive dividend from a Singapore tax resident company is considered as a one-tier dividend income. It is exempt from tax and it is not taxable, right? Interest from deposits with banks, finance company is taxable and accrues to depositor on the date it is payable to the depositor. So regardless whether the interest is withdrawn or left in the account, this interest is accrued to an individual is tax exempt, but interest accrued to a company is taxable. All right. So remember, interest accrued to a company is taxable. And discount is a deduction made from the amount of debt security. The discount accrues on the date that it is realized, right? For pension, section 10.1e, we have pension, charge, and annuity. Pension is actually a lump sum of period, a lump sum money that is paid to an individual after his retirement. So the charge refers to income received by virtue of the deed or court order. Annuity is a recurring annual payment that arises from the purchase of insurance policy. And Section 10(1)(e) is more likely applicable to individual tax, right? So for Section 10(1)(f), we have rent, royalty, and any other profits arising from property. So we have rent money received for the use of the property, and royalties are payment received for the right to use patents, copyright, design of trademarks, and they are taxable on the date it is due payable and not on the actual date of receipt. Okay? So we have Section 10(1)(g), which is considered a catch-all section. It refers to any income that does not fall within the above, but the income must be of the receipt must be of an income nature. Okay. So Section 10(1)(a), under Section 10(1)(a), only persons carry on trade, business, profession, or vocation can claim capital allowances or losses. Since trade and businesses are not defined in the Act, we will use badges of trade to determine whether a trade exists. Okay, so factors to determine whether a trade exists, we will look at the subject matter of realization. What is the nature of the assets? Is the assets used in the how is the assets used in the company business? And also we look at the quantity. Okay, so for example, toilet paper, whiskey stocks, and shares. We will look at the quantum that is purchased, whether it's the amount that is used to purchase, like the number of toilet papers for personal use, or if you buy cartons of toilet papers, will it be considered as trade or is it for use? Okay, so we will look at the subject matter in relation to the businesses, how it is used in the business, right? Then we look at the length of period of ownership. The longer you hold the asset, it is more likely to be capital, right? Because you will use these assets to derive profits for your business. And the frequency of and similar number of transactions by the same person. So if you have more of the similar transaction, it is more likely to be a trade as compared to isolated transactions. Okay, these are the 3 factors. We have 10 factors in the badges of trades. So not all 10 are applicable. You have to see which are the applicable ones. So for the first, I would say first 6 or 7 would be more applicable sometimes, more widely used. So the 4th one, we will look at the supplementary work in connection with the property realized. Any work that is done to make the assets more marketable. So any, for example, you are buying and selling, you are trying to sell a property. So whether there's any work done, to make the property more marketable, like, now a lot of condos project, right? They will have the showrooms. Then they have property developer that is selling a number of similar transactions. So they have many of the frequent transactions and circumstances responsible for realization, whether is there any organized activity to promote that particular sale. So there's showrooms and things like that, more indicative that it is a trading, right? And also the motive of acquiring the assets. Okay, so the motive is whether a particular asset is acquired with the intention to sell for the profit. So at that point in time, when the company purchased this particular asset, okay, when it disposes it, okay, does it buy this asset for the purpose to dispose it, or whether they buy this asset for the company use? Okay, so we look at the motive at the point in time when the company acquired these assets. Okay, we will look back to the time of purchase. We also look at the methods of finance, whether when the company buy this asset, is he able to hold the asset for long term? So if the company doesn't have the financial capability to hold the asset for long term, it's more likely that they will sell it in the short term more likely to indicate that it is trading, right? And number 8, whether a person already has trading interest in the same field, whether it is a similar connected transactions. If the transaction in question is closely related to the person's existing trade, it may indicate that the transaction was also entered in a matter of trade, right? So we look at the company existing trade, and you have similar transaction, more likely that transaction will be regarded similar as indication of a trade. And the way in which the assets were acquired, whether the assets will be given to by way of gift or inheritance, then it is more harder to prove that it is trading, because you also have to consider how you acquire the particular assets. If it is a gift and inheritance, you have no motive of acquiring that particular assets in the first place, right? And then the destination of sales proceed. So how is the sales proceed used? If the sales proceed is used in a similar transaction, so you buy a property and then you sell and then you buy again, more indicate that there is an existence of trade. Or stocks, you buy stocks, you sell again and use the proceeds to buy stocks again, then it is more similar to indicate that there is an existing of trade. Okay, so there is 10 badges of trade to consider, but do note that no one factor is conclusive on its own. It can be one factor that indicate that it is a trade, the other indicate that is not a trade. Okay, so we will have to consider all the facts of the case, and we use these badges of trade to determine whether this transaction is trade or capital in nature. Okay, so if it is a trade in nature, it is taxable. If it is capital in nature, it is not taxable. Right? Okay, let's do a poll to check an understanding whether a particular transaction, this gain, is taxable. Company A has an investment property in Sembawang. Due to the high cost of maintaining the property, Company A decided to sell property for $2 million, and Company A held the property for 15 years before the sale. This was the Company A first sale of property. So let's do a poll and check your understanding whether this should be considered as trade or capital. Okay, let me end the poll. Check the results. Okay, so the company has an investment property in Sembawang. Due to high cost of maintaining the property, company decided to sell the property for $2 million. It had held the property for 15 years before the sale, and this is the first sale of the property. So to determine whether this gain of property investment is actually trade or capital in nature, we will look at the badges of trade, right? So capital is non-taxable, while if it is a trade, then it will be taxable. So let's look at use the badges of trade in this case. So again, the taxability of the gain of the disposal of the investment depends on whether the gain is a capital gain or revenue gain. the gain is taxable if it is revenue in nature, and if it is capital in nature, it is not taxable. So we will apply the badges of trade, and let's look at the subject matter. This is one, it has a investment property, one investment property in Sembawang. There's no information that the investment property are used for the company's, how it is used for the company business activity. So for example, if it is used as a company office or it is used to derive rental income, and it will be assets and not a company trading in stock for sale. Okay, then we will look at the length of ownership. The company owned the property for 15 years before the sale. So 15 years is considered a long period of time. It can indicate as a capital investment. And we look at the frequency and number of similar transactions by company A. This is a company A first sale of property. Like if it is a first sale of property and there's no general pattern of trading, it will also indicate that this particular investment property, the gains are not, and this investment property is not for trading, and the gains are also not taxable. Then we look at the supplementary work in connection with the property realized, and if there's any supplementary work done to bring the property in more marketable conditions, all right, that is not provided here. We can consider that as well. Circumstances responsible for the sale. Why did the company sell this asset? Right, the company sold the asset is due to the high maintenance cost. Okay, due to the second bullet point, due to the high cost of maintaining the property, right? The company decided to sell. So the circumstances of sale did not suggest the company intend to dealing in properties. Okay, then we also look at the motive at the point in time when the company A acquired the investment property 15 years ago. Why did they acquire this property? Okay, if the property is acquired to carry on its trade, then it is indicative that the acquisition of property is not for buy and sell, right? So based on the analysis, we can conclude that the gain on disposal of the investment property in Sembawang is capital in nature and therefore not subject to tax. Okay, so let's look at how we should treat this gain that is not taxable. Assuming that the company has sold this property and this gain is recorded in the company profit and loss account. So this gain is not taxable. We will have to exclude them from the net profit before tax to arrive at the chargeable amount. Okay, so we have to less out this gain from the net profit before tax. Remember, tax com, first line item is always net profit before tax. If the receipts has been included in the net profit before tax that is not subject to tax, it is capital in nature, not subject to tax, we will have to less out the amount so that we do not bring that amount to tax. Okay? Are there any questions? The quiz on revenue and capital receipts for the franchise. Okay, let me see. Franchise. Okay, so for this particular quiz, okay, the compensation money was actually for to terminate the franchise, right? So we will have to consider whether that particular franchise in the whole context of the business. So if let's say this franchise is only one franchise that the company has signed a contract, and the termination of this franchise, which essentially make up the entire profit making structure of the company. So once the franchise is being terminated, the company will not be able to carry on its business as a franchisee, right? and then the entire profit-making structure of the company will be considered as destroyed. So the signing of this contract, the franchise contract, is not considered as one of the ordinary trading contracts. So it will be considered as the compensation money received for the termination of franchise will be considered as capital receipts. Okay. I'm repeating this because there's a chat requesting to repeat this. Are there any other questions regarding income, capital receipts? Any reactions? If you're okay, can you give me a thumbs up so I know that you're still with me? Any other questions? Okay, if we have no questions, then we'll take a 15 minutes break before we continue on the, let me see, the next topic will be the general deduction principles. Okay. Lei Hong, are you there?
Yes.
Okay.
Someone asking a question.
I don't.
Sure why they addressed to me.
Oh, I can't see it. Yeah.
Yeah, maybe I'll just repost in the chat.
Okay, can. Thank you. Okay, the supplementary slides are actually the trading company is more of the common tax company broad base. Okay, so the supplementary slides is more to give you a understanding that besides the partial tax exemption, we also have new tax exemption. We have tax exemption for new startup companies, and besides trading company, we also have investment holding company. Okay. Oh, okay. I start the time now. Okay, so we will end. We will take a break and we will come back before the timer goes to 0. I will continue to address the questions in the chat when we are back from our break. All right. If you have more questions, you can also drop the questions inside the chat box so that we can address this after the break. Okay, see you in a while.
yeah. It's gong gong. Gong gong. Does it help? Yeah. A bit lah, a bit lah. Oh no, that's not cooler. That one is a light. Actually.
Oh yeah, that's why you light up this one.
No, it's a light only. That's why I never.
Oh, I thought cooler is
It's the mine.
I know.
It's the light. It's the light. Cooler is here. This one small, then this one. Or maybe it takes time.
Now it feels even weirder.
Huh?
Now it doesn't feel cool anymore. But now you see, you just need to see the light. You see, now on the light, now you can see.
I know it's cool. See? Yeah, never mind. Anyway.
I think your ice pack is not. I think maybe because your ice pack not fully covered as well. Oops. Okay, I try tilting the thing sideways so that it covers more area.
Oh
It
yes,
covers more
maybe.
area.
Try. Hopefully works. Pay $50 for this thing. But maybe the room is too big. No, it's just them. 2 people. Maybe it is hot.
Yeah, the more area covered.
It is hot.
Is both sides hot or what?
I got 2 actually. But no need lah. Must add water later.
I think it will be too better.
Maybe the roll. I want to roll it. See?
Cannot.
Lagi drag. Oh my goodness. Dia explain lebih parah daripada Pengyang punya last time. Oh my, kayak baca skrip. Okay, I take class. I would don't even understand what the hell they're talking about. Dia kayak baca skrip gitu. Terus sudah hampir aku yang nenek sampai mau tidur.
Yang lalu mana mungkin mau dengan video lah bisa tempat.
No, but need to know mah. Ada dia.
Oh,
Dia tested kok. YA 2023 ya, bukan 2024 ya. Aneh ya. Testednya YA 2023 ni financial year 2022. I don't know leh, sampai I clarify there. They say yes, YA 2023 ah, what the hell. Okay lah. Oh, that one.
Darah lebih challenge, ada challenge.
Okay lah, we already put some cooler, you know.
Soft.
Is it? We already put some cooler, you know. Improve cooler, see whether it works. Wanna die already like last time. No, last time we buy the Xiaomi ma, but not very.
You mean you have it all?
No, last time we buy Xiaomi, then I give to Thrice. You ever even sleep with it? Tapi rasanya ini mungkin agak improve sedikit loh. Ada ice apa? Ice cube. Got ice box. Ice. Okay, mulai. Got ice cube.
Kamarnya tak smell funny ni kira-kira.
Oh, is this smell funny? Oh yeah, Papi also says smell funny.
Kalau tadi orang bilang je.
No, on they want so many we on.
Don't on lah.
See red.
Is this smell funny?
It means the quality of the air not too good. If red color means not so good. If green is good.
It's been like that.
Hello, welcome back. Okay, I will address some of the questions in the chat. So I have already addressed the revenue versus capital receipts for the contract for franchise. So the supplementary slides, I'm not sure everyone was there when I was addressing this. So supplementary slides, like the investment holding company and the tax exemption, is more for your understanding to understand whether research trading company that is also investment holding company. And investment holding companies are companies that derive passive source income like dividends, dividends, rental, and interest income. So then we also have the tax exemption for the new startup companies. So besides the partial tax exemption that the companies can enjoy, they also can enjoy this full tax exemption for the first 3 years if it is a new startup company. Right? So for the fair value, there's a question on the fair value mark to market gain unrealized for company, holding company, is it taxable? So we go back to what we have learned earlier on, whether an receipt is taxable or not. It really looks at the context of that receipt with the nature of the company businesses to determine whether it is capital or revenue. Then we can conclude whether it is taxable or not. If it is a revenue nature, then it will be taxable. And if it is capital in nature, then it will not be taxable. Okay? Screen. Okay.
Rebecca, I think your voice a bit soft again.
Soft again. I haven't started yet. So can
Oh.
you hear me just now when I was addressing the investment holding company? Can you hear me?
Yes.
Yes, huh? Okay, good. Thank you. Okay, I have a question for trading company tax computation example. Can we start the tax computation from net profit before tax of 180,000 plus 800 plus this? Okay, so I think you are referring to slide 11. Okay, so for slide 11, because the amount, they did not provide a net profit before tax amount. So, right, so if you add up the net profit, you add up the amount to arrive at the net profit before tax, then you can use this format, okay? Because always we look at the net profit before tax for a trading company tax computation. So in this case, because they do not have the net profit before tax, that's why we have added up them category by category. So that's computation. Yeah, so the question is, yes, we can add up to find the net profit before tax, and then we will less out, we will add back the 20,000, and we will less out the dividend income, and to find the chargeable income, because the rental income have already been added in the P&L. Okay. Okay, so let's recap on what we have learned before the break. We have learned about the tax computation that is prepared based on the provisions of the Income Tax Act. Okay, we also have learned that the tax computation is prepared based on the the tax computation is actually prepared based on the Provision of Income Tax Act 1947. Okay, and the format of the trading tax computation is starts from the net profit before tax and the various tax adjustments to arrive at the adjusted trading profits. So what are the adjustments? It excludes the non-taxable receipts and non-deductible expenses if they have been already included in the profit and loss, the net profit before tax. And we also exclude the investment income and related expenses. And this is to find out what is the adjusted trading profit. So investment incomes and related expenses does not form part of the trading profit will be excluded to find out the adjusted profit before tax. Then we also less out the expenses that qualify for further deduction and revenue expenses that has been capitalized in the balance sheet. Okay, so we will deduct the amount, these expenses. Then we will be able to find the adjusted trading profit, and thereafter we can less out the capital allowances. And earlier on, if we have less out the investment allowance, we will add back the investment income. Earlier on we have exclude the investment income. Now we will add back the investment income to arrive at the statutory income, and we will deduct the donations to the approved PIC to arrive at the chargeable income. So that one is on slide 8 and 9 to show about the tax computation. And at slide 25 onwards, we also talk about the basis period, where Singapore adopts a preceding year basis to tax all sources of income. So for corporate tax, the basis period is the accounting period ending on any date in the preceding year. So you look at the accounting year end plus 1 year, that is the year assessment. And from slide 29, we do mention about the year assessment 2023, the tax rate is 17%, and there's partial tax exemption for year assessment 2023, that is 75% on the first 10,000 and 50% on the next 190,000. So if the income is, if the company has a chargeable income of at least 200,000, it can claim the full amount of the partial tax exemption of $102,500. Okay, and from slide 30 onwards, we also talk about the general charging principles. We identify that there's two types of receipts. One is capital receipts and one is revenue receipts. Capital receipts are not taxable, revenue receipts are taxable. And there is no definition in the Income Tax Act 1947 on what is capital receipts or revenue receipts. So we will take guidance from the principle established in the case law to distinguish the receipts, whether it is capital in nature or revenue in nature. Okay, and we also, to distinguish the receipts, whether it's capital or revenue in nature, we can also consider whether the receipt is relating to the assets which form part of the permanent structure of the businesses, or whether it is a fixed or capital, fixed or circulating capital. And we also have 5 basic propositions from the White Man's Income Tax Act, income tax, to determine whether that particular receipt is capital or revenue. Okay, so after we determine capital receipts, we also, at slide 41, we also talk about the charging section in the Income Tax Act. Section 10(1) is the charging section. To determine what are the income that is chargeable to tax. And we also have section 13. So if, let's say, the income is chargeable to tax under section 10(1), but it is exempt under section 13, it will not be subject to tax. So I cited that example about the dividend. It is chargeable to tax under section 10(1), but hey, because section 13, it mentioned that any dividend received from a Singapore resident company is considered as one-tier dividend, is exempt from tax, so we will not bring it to tax. So we have that example at the earlier slides, example on the trading company. I think that is at slide 11. Okay, then we also have section 10(1)(a), gain from profits from trade, business, professional vocation, where we use the badges of trade to determine whether the trade exists, and if only person that carry on a trade or business can claim capital allowance or losses. So it is important for us to find out whether that particular transaction is that particular transaction is considered as trade, so that a company could claim capital allowances or losses, or to use badges of trade to determine whether the transaction of that gain is trade in nature or capital in nature. If it is capital in nature, it is not taxable. When it is trade in nature, it is taxable. Of course, if it is trade in nature, we can claim capital allowances and losses. Okay, then I think we have mainly covered all the things on before the break. Okay, so let's move on to general deduction principles. Whether the particular expenditure, so just now we talked about receipt, now we will talk about the expenditure, whether the expenditure is allowable or not allowable for deduction. Okay, so again, we look at the Income Tax Act. Income Tax Act says that Section 14, it provides for what is allowable, what kind of expenditure is allowable, and Section 15 tells us what type of deduction is not allowable. Okay, so in Section 14(1), of the Income Tax Act, it actually provides a general deduction formula. Okay, there are specific deduction under Section 14, which provides the amount of deduction allowable for deduction. So, for example, medical expenses, they do dictate like how much of the medical expenses is deductible. There are also specific deduction provisions provided under Section 14, capital A to capital ZF. They also provide some of the deductions that is not covered under Section 14.1. For example, research and development expenses or further deductions or some of the Section 14N deduction like renovation and refurbishment expenses. Then come to Section 15, it will tell us what are the expenses that is not allowable for deduction. So in GIS, we have to claim a deduction on the expenditure. It must be allowable under Section 14 and not disallowed under Section 15. So that means if the expenses is allowable under Section 14, we must make sure that it is not caught under Section 15. All right. So if all the expenses are included in the profit and loss, so we will remove those expenses that are not deductible. Okay, so by removing it from the net profit before tax, we mean that we add back the amount because remember for the net profit for the tax computation, we always start at the net profit before tax line item. Okay, and that we have already deducted all the expenses that is needed to generate the income. And we want to identify what are the expenses that is not deductible, so we will add back those not deductible expenses. So which means by doing so, we disallow certain expenses. By doing so, we are increasing the chargeable income. Okay. Okay, so for receipts, we do have to differentiate the capital revenue divide, and for expenses, it is also the same. We have to identify what is capital versus what is revenue expenses, right? So we have once and for all expenditure. Expenditure that is once and for all is likely to be capital expenses as compared to those of a recurring nature. So like entrance fee versus the annual subscription fee. Okay, this kind of annual entrance fee is once for all, so they are not deductible. And annual fee will be annual subscription fee will be recurring nature, then it's deductible. And we also look at the expenditure, whether is there any enduring benefit for incurring that expenditure. So if let's say the expenditure bring in an existence of assets, okay, and there's an advantage of enduring benefits for the benefit of the company future, okay. So the expenditure will help to be capital in nature, and once it is held in capital in nature, it is not deductible, and we have to add back the amount if it is in the profit and loss included in the profit and loss account. So for example, things like enduring benefit of trade is like new business license or the company, the incorporation of the company expenses. And we also look at fixed and circulating capital. So fixed and circulating capital and fixed assets. Fixed capital is like a fixed asset, and circulating capital is like trading stocks that is revenue in nature. And then we have identifiable assets, which we can simply capital assets that can be identified for which the payment is made. So we will have to we do have intangible assets, right? We have patents and trademarks which are intangibles. Then we have plant and machineries that are tangible. So we have to identify what the company is paying for, what type of assets. Okay. So again, like receipts, we have capital and revenue differences. We also have capital and revenue expenditure. So capital expenditure is not deductible, while revenue expenditure is deductible. Capital expenditure has connotes a permanence, and it is for the acquiring of an enduring benefits, whereas for revenue, it is more of the recurring nature and operational in nature. There are certain tests that we can do to test whether the expenditure is capital revenue. So again, it is once and for all versus recurring that we have covered on earlier, and expenditure to acquire an enduring benefits like business license, incorporation fee, expenditure to fixed capital or circulating capital, whether it is a fixed asset or the business inventory. And we also have other factors to consider, but they are non-conclusive factors. They include lump sum payment versus periodic payment, the magnitude of the expenditure, the capital receipts does not necessarily spells to be capital disbursement. For example, a trading company that sells an old van to a second-hand car dealer. So the sales proceed is capital receipts to the trading company, but it is a revenue payment by the dealer company. So it doesn't mean that the seller is recognizing it as a capital and the buyer will always recognize it as capital. Okay, we always look at the nature of business to determine whether the capital, the receipts or the expenditure is capital revenue in nature. All right, so payment out of the capital, for example, purchasing trading stocks using the proceeds from the sales of share would not convert the expenditure into one that is capital in nature. Okay, so if let's say the sales of the company is using capital receipts to buy to pay for revenue expenditure, we do not look at whether the source of the source of the payment actually is a capital in nature, so my expenditure will be capital. We always look at the identify that particular expenditure, what are we paying for in relation to the business. Okay, so we also look at the accounting entries like fixed assets that is expense of. So doesn't mean that expenditure in the P&L is always revenue in nature. Okay, they do have capital expenditure included in the profit and loss account. For example, fixed assets. Sometimes company do buy smartphones, okay, because the amount is not so substantial as compared to their fixed assets, right? They will expense off to the P&L. But do note that these smartphones are actually used for the company business, right? So it's like the capital assets, fixed assets to the company. So they are actually capital expenditure and they are not allowable for deduction under Section 40. Okay, I have a question for the HP principal and interest payment. Okay, lump sum versus periodic. Okay, I have okay, for example, we have the company buy a van. All right, they buy a van and the van on a hire purchase. So if they buy a van on a hire purchase, usually a hire purchase company will charge interest on the hire purchase. The cost of the assets, right? So for example, if let's say the cost of the van is about 100,000, then the interest that the company is paying is maybe about 10,000. Okay, a very steep 10%. Okay, so this principal that you are paying is actually the cost of the assets, the van. Okay, but it is divided over a period of time. So does it mean that by paying this over a period of time, it qualifies as revenue expenses? No. Okay, we always look at the nature of the expenditure that the company is incurring. As for the interest payment, okay, we look at the interest. Again, we have to look at the the assets of the company. If let's say the company purchased the van and the interest payment will be regarded as a way of financing the purchase, right? So it is incurred in the production of the income. If let's say the van is used in the company businesses, then the expenses, the interest payment is deductible. Okay. Any other questions? Okay. Now let's move to. Okay. Again, we have to always address back what is deductible, what is not deductible. We always look at the Income Tax Act, Section 14 and Section 15. Section 14 spell out the rules that is deductible. Section 15 disallows certain deductions. So it actually overrides the general deduction rule in Section 14(1). So if let's say expenses, it is allowable under Section 14(1), but then we have to go back to look at Section 15 and make sure that it is not specifically excluded. That means not specifically disallowed under Section 15. I think I have a chat. Let me have a look.
So the right side is completely sure. So apparently X and Y is very clear.
Okay, so for installments under hire purchase, we do have to split the principal as well as the interest and to work out the amount that is deductible. This will be covered under in the next session where we are talking about the capital allowance. There will be a part on the hire purchase. Okay.
X and Z is clear. X must be blocked.
Okay, so we have been talking about Section 41 have a general deduction formula. So what is exactly that formula that we are talking about? So let's look at Section 14(1) in the Income Tax Act 1947. In the Section 41, it actually says that for the purpose of ascertaining the income of any person for any period from any sources chargeable with tax under this Act, there are to be deducted all outgoing and expenses wholly and exclusively incurred during that period by that person in the production of the income. Take note of the wording in bold. We are going to dissect that and to understand a bit more about what is this sentence means. The other formulas, right? So in Section 41, it says to ascertain the income chargeable with tax. So we want to know that for that particular income that's chargeable to tax, what is the expenses that has incurred to earn that income that is chargeable to tax. Okay, so that means in the expenses, we must be able to identify these expenses is for which income, right? Then if let's say the expenses is for a multiple income, we will look at the other rule. So expenses incurred to derive foreign income. If the foreign income is not remitted into Singapore, such expenses cannot be used to deduct against other income. So again, we must identify the expenses to the income. So if the expenses is incurred to derive foreign income, then and the foreign income is not remitted. So if it is not remitted, it is not subject to tax, and then the expenses incurred for this foreign income will not be allowable for deduction. Okay, just now we mentioned that there's three things in the general 14(1) deduction formula. It actually have the requirement of it must be incurred during the basis period for the year assessment concern. It must be wholly and exclusively and in the production of the income. So what does incurred means? Incurred does not mean that it is paid. It means that the liability has crystallized in both the law and in quantum. So even if there is a liability to pay but have not been paid, so it is considered as incurred. Okay, so it doesn't include any contingent liability or general provision, because general provisions are expenses that has not really been incurred, and contingent liability is a liability that is in contingency and it's not really a liability at the point in time. Okay, so incurred doesn't mean paid, so we have to look at whether the expenditure has been incurred or not. So for example, general provision of bonus, unutilized leave, etc. are not deductible as they are not incurred. Okay, only provision that is utilized is allowable for deduction. So it's when you utilize it, you only utilize it when it is incurred, right? So then you will allow for deduction. So again, if let's say there's general provision included in the profit and loss and they are not deductible, what do? You will add back the amount. Okay, by disallowing the amount, you actually increase your chargeable income. Another criteria, we have to look at whether the expenditure is wholly and exclusively. Wholly and exclusively means that it must be for one purpose, it must not be for dual purpose. So in practice, right, CIT actually the Controller of Income Tax actually allows a reasonable portion of the expenditure incurred in the production of the income. So this is in practice, but in the Act we say that the expenditure must be wholly and exclusively incurred. Okay, so this can also, if you're interested, you can also read up more on the case law provided in the slides. Okay. And in the production of the income, so it must have a close connection between the expenditure incurred and the income producing activity. All right, so for example, what is the expenditure that is incurred to produce that particular income? So if expenses to which the income has not commenced, it's not allowable for deduction under Section 14(1). Okay, because it's not in the production of income yet, right? So, but under Section 14(1), it's not allowable, but there is a pre-commencement expenses incurred within 12 months before the first dollar income is allowable, before the first dollar income is earned, is allowable under Section 14(R). So, general section formula says that the expenditure must be incurred in the production of the income. So it must be incurred wholly and exclusively in the production of income. This is the general formula. If let's say the general formula says that it is incurred in the wholly and exclusively in the production of income, it doesn't fall under the general formula. We look at those under Section 14, we have to capital A to ZF to see whether this expenditure, does it fall under the provision of Section 14A to ZF, to see whether it can qualify for deduction under those sections. Okay. So Section 14(1), there's certain expenditure that spelled under Section 14(1), for example, interest and qualifying borrowing costs. So Section 14(1)(a) allow deduction on interest and qualifying borrowing costs. There must be a direct link between the use of the loan, okay, for which the interest is being paid, right, and the income produced, where the direct identification and tracking of the interest-bearing loan to the assets cannot be established. That means there is no direct link between the use of the expenses and the income. The expenses will not be allowable for deduction under Section 14(1)(a). Okay. However, just to share that in practice, Controller of Income Tax has exercised administrative discretion to allow a portion of the common interest expenses attributable to income producing asset by using a total assets method. Okay. Under Section 14(1)(b), we have rent expenses. Rent expenses is allowable for deduction if it is incurred in the production of income. We have repair and maintenance used for the business. Repair is restoration by renewal or replacement of subsidiary or part of whole. and the renewal is the construction of the entirety, not necessarily whole, but substantially whole. So the cost of renewal relating to any plant, machinery, okay, or cost of building and structures are not qualified for deduction, not allowable for deduction. Okay, so we have to add back this. And Section 41 also says provides for the bad debts and doubtful debt. So in order to qualify for deduction for bad debts and doubtful debt, the debt must be bad. Okay, so the debt must also be included in the trading receipts previously. All right, so these are the two criteria. And there's also, because of the adoption of FRS 109, the Section 41 also actually provides some provisions under whether the credit impaired, whether the provision is credit impaired or not. So non-credit impaired trade debts are not deductible. Only credit impaired trade debts are deductible, right? And Section 14(1)(e) also provides contributions to pension provident funds like our CPF. Okay, these are statutory contribution to CPF is allowable for deduction, but voluntary amount contribution to the employee's CPF contribution is not allowable for deduction. Okay, statutory is allowable, non-statutory, voluntary is not allowable. And we have to add back the non-allowable amount. Okay, then contribution to MediSave account, that is allowable but subject to a cap, and contribution to Zakat, Fitrah, and other religious due is also allowable for deduction. Okay, so under Section 14(1), we move on to Section 15, Section 14(5) and 8. Let me see the chat. Okay, rent office is also necessary for operating a manufacturing plant. Is rental a portion to office not deductible? So when there is an office, I presume that in the manufacturing plant there is office as well. The office is part of the company's trade. Okay, so both the office, the rent for the office as well as the manufacturing plant is deductible. There's no need to mention the sections in specifically the sections, but the broad base, like Section 14, you must know that okay, the entire concept of how the Income Tax Act is structured. Section 10 is charging income. Section 14 is deduction. Section 15 is expenses that is not allowable for deduction. Okay, Section 19 is capital allowance. You need to know about all this so that you can apply the correct tax treatment, because under various sections there are different ways of computing the expenses. For example, medical expenses that I'm going to touch on. So for Section 41, we talk about the general formula. Okay, deductible or not deductible, but we didn't actually say about whether how much is deductible or how much is not deductible. So the expenses under Section 41 must be wholly and exclusively incurred in the production or income. It must not have a dual purpose. Okay, as long as don't have a dual purpose, we allow the entire thing. If there is dual purpose, then we will see whether in practice, if there is any apportionment, or in practice, or if there is any other deduction allowed under Section 14A or Section 14ZF or the rest of the Section 14. Okay. So let's move to the medical expenses restriction. Okay, so for medical expenses, generally it is deductible, but only deductible to a certain amount. And we need to know how much is deductible and how much is not deductible. And those amount that is not deductible, not allowable for deduction, will be added back to increase the chargeable income. Okay, so first of all, we must know what are considered as medical expenses. We have a full range of medical expenses here, full range of medical expenses, maternity health care, natal care, preventive therapeutic treatments and things like that. So dental care, allowance in lieu of medical expenses. Okay, all these are at medical expenses allowable for deduction. But how much, we will take a look at the later slide. Okay, so medical expenses is restricted to either 1% or 2% of the total employee remuneration. So section 14.5 to 14.8 actually provide a cap on how much medical expenses can be allowable for deduction. Okay, so it is capped at 1 or 2% of the total employee remuneration. Okay, what is included in the employee remuneration? Employee salary, allowance, bonus, director's remuneration, and CPF contribution. Okay, so in the employee's remuneration in the P&L, you may also have director's fee, medical expenses, cash allowance in lieu of medical expenses, benefit in kind, skill development levy, and foreign worker levy. All these could have included in the employee remuneration in the profit and loss account. But do note that for the purpose of computing medical expenses restriction, only include employee salary, allowance, bonus, director's remuneration, and CPF contribution, and multiply by 1% or 2%, and that's the amount that is allowable for deduction, the medical expenses. Okay, any excess of the medical expenses, the medical expenses in excess of the 1 or 2% is not allowable for deduction and has to be added back. So when do we apply 1% or when do we apply 2%? Okay, generally it's 1%. However, if the company implements any of this scheme, it is 2% of the remuneration. Okay, employee remuneration 2%. So generally it's 1%. Unless the company has implemented any of these, it is 2% of the remuneration. Any amount, medical expenses in excess of the allowable medical expenses has to be added back. Let me check I have a question on is provision for bonus deductible expenses. For example, for the year 2022, company book provision accrued for bonus year 2022 in the P&L because it is paid to the employee only in the year 2023. Is this provision for bonus deductible? Then we will have to look at what kind of provision is this. If this bonus is a contractual bonus, that means maybe a year and 13-month bonus, so it is only payable in the following salary payment, then yes, this accrued bonus is deductible in the year 2022. If it is not contractual and this is discretionary, you only know that at the end of the following year, then this amount will be deductible only in the following year. And the next chat I have is the difference between director remuneration and director fee. Director refers to the board members. Okay, so sometimes people do, employee do have a title called director, but they are actually employee. So they are high level employee. So they are like normal employees that also handle the day-to-day operations. So they are provided with a director remuneration. Whereas for director fee, they may or may not be involved in the day-to-day operations. Okay, so we do not regard that as a staff or employee salary. Severance or gratuity payment, is it included under remuneration when computing the medical expenses? Okay, generally, it is not. We have to determine whether the severance or gratuity payment is part and parcel of the employee's remuneration package. Okay, so that one we have to consider further, and how the severance and gratuity is being considered as the remuneration of the employee. If it is not, then it is not. If it is not part of the employee remuneration, then it is not included for computing medical expenses. Okay, so just now I mentioned that expenses, medical expenses in excess of the 1 or 2% of the employee remuneration is not allowable for deduction if the medical expenses have already been included in the profit and loss. We have to add back the excess amount. So for this example, there's a total medical expenses of 6,000 and the total remuneration of 500,000. Assuming that the company didn't have any of the scheme, we will cap the allowable medical expenses to 1% of the total remuneration. So 1% of 500,000 is 5,000, but the medical expenses is 6,000. So 6,000 minus 1,000, the amount that is disallowed for medical expenses is 1,000, and we have to add back the 1,000 to the tax computation, in the tax computation. Okay, let's do a quiz and a short poll to test your understanding on excess medical expenses. We have a medical expenses of 9,000, medical insurance of 5,000, cash allowance in lieu of medical expenses of 10,000, employee salary, bonus, CPF 800,000, director remuneration 200,000, director fee 20,000, foreign worker levy 7,000. Assume that the company did not implement any of the portable medical benefit scheme. So can you compute and let me know how much is what's the question? Excess medical expenses. First of all, determine what are medical expenses, what are employee remuneration, then apply the correct percentage, either 1 or 2%, and less out the amount, the medical expenses, less out the allowable medical expenses to find the excess medical expenses that is not allowable for deduction.
The human has 6 stages? I didn't know that. Okay. Okay, no wonder. There's 6 stages, okay. Makes sense.
Okay, I will end the poll and share the results. Okay, so the medical expenses, the excess medical expenses is 14,000. Let's walk through this together. I'm not sure if you all have slides 203. The answer is at slide 203. Do you have slide 203? Hello.
Yes.
Okay, thank you. Slide 203. Okay, don't have, it's okay. I go through slide 203. Okay. Slide 203. Okay. Okay, for those who have, you can refer to your notes. For those who don't have, I'm sharing the slide 203. So just now we mentioned about the medical expenses, right? We need to first identify what are the medical expenses. So we have medical expenses of 9,000, medical insurance of 5,000, and we have a cash allowance in lieu of medical expenses. So these are kind of medical expenses allowance. That is 10,000. So the medical expenses, total medical expenses is 24,000. The second step is we identify what is staff remuneration. So for employee salary, bonus, and CPF is 800,000. Director remuneration is 200,000. And it comes out to be 1 million. Director fee, they may not be involved in the day-to-day operation, so they are excluded from the employee remuneration. So same as foreign worker levy, it is also not part of the staff remuneration, so they are excluded. So after we identify 1 and 2, we will use 2 to apply whether it's 1% or 2%. So how much is the allowable medical expenses since the company did not implement any portable medical benefit scheme? The medical expenses allowed is capped at 1% of the staff remuneration, okay, which is 10,000. Okay, then step 4, we will compute the excess medical expenses. So we get the total medical expenses that we have determined at step 1 of 24,000. We less off the 10,000 allowable medical expenses that we determined at step 3 to arrive at 14,000. Okay. Any questions on medical expenses? If not, we go back to slide 73. Okay, slide 74. Okay, so just now we are at slide 73. Now we are at slide 74. So remember just now we mentioned about under the general deduction principle, we have section 14.1, which has a general deduction formula that expenses must be incurred wholly and exclusively in the production of income. Then we have medical expenses that is also not under section 14.1, but section 14.5 to 8, where there is certain restriction on the amount of medical expenses allowed. Then we have the section 14A, capital A to section 14, capital ZF. These are deductions of expenditure that generally do not satisfy the general deduction formula, or these are the provisions that provide for further deduction of the expenses, even though they have been allowed under section 14.1. Okay. So if the expenses for Section 14 capital A to Section 14 capital ZF, if let's say the expenses have been included in the P&L, okay, so and it has been allowed further deduction, so we will less off that amount that is allowable as provided under the Act. Okay, if let's say the expenses have already been included in the P&L, but it is not a further deduction, it's just a normal deduction. So anything that is deductible is already included as is already less out in the profits, right? So there's no further adjustment to that. Okay. Okay, let's talk about some of the specific deduction provision that is not provided under Section 14(1), and is there could be Section 14(n), that is a deduction for renovation or refurbishment expenditure, or Section 14(b), that is statutory and regulatory expenses. Section 14(zf) covers the deduction for expenditure incurred on immovable property while vacant. So they are not incurred in the production of income. So they are disallowed under Section 14(1), but it is allowable under Section 14(zf). Okay. So Section 14(n). Section 14(n) is a deduction on R&R costs. R&R means renovation and refurbishment expenditure. Okay, any person who carries on a trade, business, profession, okay, under Section 10(1)(a), is allowable to claim tax deduction incurred for renovation and refurbishment expenditure under Section 14(n). So it must be a trade source income. And the qualifying expenditure for this renovation and refurbishment cost is 300,000. But this 300,000 is for a period of 3 years. So it's not 300,000 for every year, it's 300,000 for a period of 3 years. And the companies can claim the deduction on the qualifying expenditure incurred for each of the year that they have incurred over 3 consecutive years. Okay, and this deduction cannot be deferred. And companies who choose to claim, if company has incurred renovation and refurbishment costs in a year of assessment 2021, 2022, and 2024, can choose to claim deduction on the qualifying renovation and refurbishment costs over 1 year instead of 3 years. Okay, so these are the rules for deduction. We will get to more steps on these proper steps to give you a better understanding on how to compute this Section 14(n) deduction in the later slides. Okay, so the first step, we need to know what is qualifying renovation and refurbishment costs. Okay, so they are actually in expenditure incurred on fixture fittings, for example, renovation, okay, on the work done on the business premises. Okay, it's not any other premises, it's not the employee premises, it's not the employees, even though the company has provided staff accommodation for the employees, it's not on the staff accommodation that the company did a renovation for the staff. Okay, but the renovation of the business premises. Okay, and these are the expenses that is allowable, qualifying renovation and refurbishment qualifying expenditure. Okay, general electrical installation, general lighting, hot and cold water system, kitchen fittings, sanitary fittings, doors, gates, roller shutters, fixed partition, glass or otherwise. We have flooring, marble, tiles, laminated wood, okay, any floorings, and false ceiling, cornices, fittings in the retail outlets or the hacking work on the premises. Okay, these are qualifying. That means they are allowable for deduction. Okay, qualifying. These are non-qualifying. If the company has incurred any of this expenditure, they are not allowable for deduction. Okay, R&R work that require the approval of Commission of Building Control. So if usually this kind of case are quite major kind of renovation and refurbishment that require approval, okay, from the building control, then these are not allowable for. They are not qualifying R&R costs. Okay, designer and professional fees, antique, fine art, work carried out on the place of residence provided to employee. Just now I mentioned about staff accommodation. Okay, these are not qualifying R&R costs. And R&R costs qualify as expenditure incurred on the purchase of plant and machinery for which the capital allowance has claimed under Section 19 or Section 19A is also not allowable. So because you would have already claimed the capital allowance on that cost, so this cost itself cannot be claimed again under Section 14N. Okay. So first step, we identify what is qualifying renovation and refurbishment expenditure. Okay. So how it works? After we have identified the qualifying R&R costs for each year, we will tabulate it in a table like this. Right? So qualifying expenditure is kept at 300,000 for every 3-year period. So the first step is we identify qualifying expenditure for each step, for each year that we have identified in the earlier 2 slides. What are qualifying and what are non-qualifying. So we identify qualifying amount for each year. So I have first identified the qualifying amount, and I know that for the year assessment 2021, I have 150,000. For 2022, I have 30,000. For 2023, I have incurred 300,000. These are qualifying amount. Then we identify what is the 3-year period, because every 3 years I will be capped at 300,000 for my expenditure, correct? So after I identify the qualifying one, I will cap the 3-year period. So I have 150 for YA 2021, 30,000 for YA 2022, and 23,000 for 300,000 for YA 2023. Okay, so then we find the 3-year period is YA 2021 to 2023, and Section 14N says that you can only claim 300,000 for this 3-year period. Okay, so since computation is done on a yearly basis, when I'm preparing tax com for YA 2021, I only have 150,000. Okay, so yeah, within the $300,000 cap. So I can claim the full amount of 150,000. Then come to YA 2022. Okay, I have incurred 150 in YA 2021. Now I incurred 30,000 in 2022. So altogether, I have only incurred 180,000. So still within the cap of 300,000 for the 3-year period. Then come to 2023. I make a big renovation, and I have identified that the qualifying renovation and refurbishment expenditure is 300,000. Okay, way beyond the 300,000 for the 3-year cap. So what do? I have claimed 150,000, I have claimed 30,000, so I can only claim 120,000 on the 3rd year. Okay, so how I arrive at 120,000? I use 300,000, I minus the 150,000 that I claimed in YA 2021 and the 30,000 in YA 2022 to arrive at 120,000. Okay, so do note that for this example, the first year of claim is YA 2021 and the last year of claim is YA 2023. Okay, then the next 3 years period will be 2024 to 2026 and apply even if there is no renovation and refurbishment expenditure incurred in 2024. So once they identify the 3-year block one, even if for that particular year, the company didn't incur any R&R costs, that particular year will still be included in that 3-year period. Okay, just that maybe let's say YA 2022 is 0, but I do not stop at 0 and restart again the 3 years. I always look at the 3-year period. Okay, so the first year is always the first claim where the company has paid. If there's no claim made in YA 2021, the amount would not qualify for deduction in the subsequent year. So if the company has qualifying expenditure, but the company choose not to claim, it doesn't want to claim for whatever reason, okay, so that amount will be forfeited. So he cannot claim in the next year or the following year, okay? Okay, so under section 14 and deduction on R&R costs, how it works under the normal renovation and refurbishment deduction, okay, usually the deduction is over a period of 3 years. Okay, so what do I mean by deduction? Just now I emphasized the word qualifying R&R expenditure. So I identify, or I go through the list of renovation that I have done. I identify what is qualifying, what is not qualifying. Then I put in the figures on qualifying expenditure here. I have YA 2021, 150,000, YA 2022, 30,000, YA 2023, 120,000. Okay, so just now it also mentioned that under section 14N, this expenditure that I have incurred, I will claim over a period of 3 years, 3 consecutive years. Okay, so if for 150,000 that I have incurred in YA 2021, I cannot claim everything in YA 2021. I will claim 50,000, 50,000, 50,000. That is for normal R&R costs, because in the section 14N, they provide for a period of 3 consecutive years. Okay. Then for YA 2022, under normal circumstances, I will claim 30,000 over a period of 3 years. So I incur the cost in YA 2023. I start claiming YA 2023. YA 2022. Then I claim in YA 2023 and YA 2024. And then in YA 2023, the qualifying amount that I can claim is 120,000 because there's a cap of 300,000, right? So this 120,000 I divided over 3 years will be under 40,000, 40,000, 40,000. So there is a normal deduction. All these are normal deduction. That's why it's over a period of 3 years. So effectively, how much do I put in my tax comp? For the year assessment 2021, I can only claim 50,000. For the year assessment 2022, I'll claim 60,000. For the year assessment 2023, I'll claim 100,000. For year assessment 2024, I'll claim 50,000. For year assessment 2025, I will claim 40,000. Okay.
Hi, Rebecca.
Yes.
For clarity, your qualifying R&R for year 2023 is 120,000. So assuming that my expenditure is 300,000, so the balance 180, I can't claim anymore. I can only
cannot claim at all. Yeah. Okay, so renovation and refurbishment expenditure, usually accountants will put it in the balance sheet. Okay. So the 180,000 cannot be claimed.
Hi, Rebecca.
Yes.
Ivana here. Hi, can I check, since we are testing on the YA 2023, are you saying that the question we will not be having the accelerated R&R and CA, the one that's within 2 years 75% and 25%?
Okay, the 75% and 25% is the capital allowance, not this deduction. Deduction is either 1 year or 3 years.
Oh yeah, sorry. Yes, I'm referring to the R&R 1 year. We also not accelerated.
So in YA 2023, it is not accelerated, but usually the company don't start at YA 2023. They do start way before that, and then they have expenditure in YA 2021 and YA 2022. So there will be certain years where they have 1 year, certain years there will be 3 years. It's based on the option of the company. So in this example, we assume that the company did not elect for the accelerated claim. So this is just to show you that in the normal circumstances where qualifying expenditure claim over a period of 3 years, this is how the computation of that normal R&R deduction will look like.
Okay, so in the terms of the exam, right? Because just now they say that the exam will be only testing on the YA 2023. If it's not say in the exam that they opt for, let's say, accelerated, then we should because YA 2023 there is no accelerated, right?
Yeah, there's no accelerated.
So
Yeah.
we do as per normal lah.
You do as per normal, but you need to look if there is anything that is for YA 2021 to YA 2022. You know, the company may also have deduction in the earlier years. They also have qualifying expenditure in the earlier years. Yeah,
Okay.
whether the company has elected for accelerated claim in YA 2021, 2022. So the accelerated claim is YA 2021, 2022, and 2024.
Okay, got it. Thank you.
Okay, yeah. I have a question in the chat. Can't YA 2022 be the first year if it is not claim YA 2021? Okay, claim 30,000 and 27,000. 2021. 30,000. Oh, okay, understand. Okay, so I have a question to say that if let's say for the first year of 2021, the company didn't claim. Okay, then the next then we should look at YA 2022, 2023, and 2024. Okay, so the 3-year relevant period is when the company first claimed. Okay, so if let's say the company has incorporated many years ago and has started claiming the R&R cost previously, so the first year where the company start claiming, it will start from that 3 years period. So that 3-year period will not change. So I assume that if let's say the company has incorporated in, let's say, YA 2028. Okay, so if YA 2028 they start to claim, then it will be 2018. So if the company has incorporated in YA 2018, okay, the 3-year period, and then it starts having qualifying R&R costs, 2018, 2019, 2020. Okay, then the next 3 years will be YA 2021, 2022, 2023. So this example is saying that if let's say the 3 years period already been locked already, if the company did not claim this 150,000, it will not qualify for deduction. I'm not sure if I have answered your question, Jean. Jean, are you there? Yes. Okay, good. Okay, we have talked about under normal circumstances, that R&R cost is claimed over a consecutive of 3 years. So there's no break. So when you start claiming 50,000, 50,000, 50,000, you cannot claim 50,000, then you jump to YA 2023 50,000 and choose to claim. It's 3 years consecutive. Okay, once claimed, it will be claimed. Once no claim at all. Okay. Okay, accelerated R&R deduction for YA 2021 and 2022. Okay, so that is under the provision of Section 14N. There is also special provision for YA 2021 and 2022. If let's say the company have qualifying R&R costs incurred in the basis period for YA 2021 and 2022, the company can have the option to claim 1 year instead of 3 years. So once the option is exercised, it's irrevocable. So what does option means? The company can choose. If the company feel like, oh, I still okay, I want to claim over 3 years instead of 1 year, then we will do a 3 years computation. But this is a choice given to company so that they can reduce more chargeable income if they claim over 1 year, right? So what happens if, let's say, I am the company is actually has elected to claim an accelerated R&R cost in YA 2022? Okay, so again, the same example, I have qualifying expenditure 150,000 in YA 2021, 30,000 in YA 2022, and 23,000 in YA. I keep saying the same thing. 120,000 in YA 2023. Okay, so for the type of deduction, you have normal deduction that is over 3 years. Okay, in the year assessment 2021. And in the year assessment 2022, the company decided to elect for the accelerated allowance. And we have a normal allowance in YA 2023. Okay, so let's do step by step. In YA 2021, the company did not elect for the accelerated. So what happens? Over 150,000 over the period of 3 years. So 50,000 for YA 2021, 50,000 for YA 2022, and 50,000 for YA 2023. Okay, for YA 2022, the company elected to claim over a period of 1 year. So the 30,000 will be claimed in full amount in YA 2022. So it will not be apportioned over 3 years, but claim here 30,000. Okay, unlike the earlier slides where we have 30,000 that is claimed over 3 years. So if the company choose to claim 30,000 over 1 year, it will be that 30,000 in the year 2022. Okay, so when it comes to YA 2023, there is no accelerated option, right? Okay, the 120,000 will be claimed over a period of 3 years. So 40,000 and 40,000. Okay, and another 40,000 YA 2025. Okay, so now after I have tabulate all this, I will look at in YA 2022 how much I'm going to deduct to find out my chargeable income. I have 50,000 deduction. In YA 2022, I have 80,000 deduction. In YA 2023, I have 90,000 deduction. In YA 2024, I have 40,000 deduction. So just now there's a question saying that, oh, if YA 2023, I can claim the accelerated. Okay, I can make this into 120,000, but I have to consider what is my election in the earlier years. Because if the company do have any expenditure in the earlier years, we also have to take into consideration what is the treatment for the earlier years to compute the amount in YA 2023. So if you see YA 2023, I do have normal deduction because I have not made an election for the assets that I acquire in YA 2022. And also I have the assets that I acquired in 2023 to arrive at the 90,000. Okay. Let me check the chat. If the company has another 100,000 qualifying R&R in YA 2024, does this mean that the company can claim another 300,000 in YA 2024-2025? Yes. So if the company, you identify the 3 years period, right? If 3 years period is YA 2021 to YA 2023, the next 3 years period will be YA 2024 to YA 2026. If let's say the company has claimed 100,000, has incurred 100,000 in YA 2024, then we will have a new 300,000 for YA 2024 to YA 2026. Okay, so that 100,000 is within that 300,000 for YA 2024 to 2026. The full 100 can be claimed. If let's say the company elected for accelerated claim for YA 2024, the full 100,000 can be claimed in year assessment 2024. If the company did not elect, then it will be 100,000 divided by 3 years, claim over 3 years.
Rebecca.
Yes.
For clarity again, the same question. So it doesn't matter whether we select accelerated or spread to 3 years. The limitation on the YA2023 120,000 will stay, even if I incur 300.
I'm sorry, your question again. It doesn't matter whether the company has claimed accelerated.
Or you spread into 3 years. So meaning that if I incur more on 300K of expenditure
in YA 2023,
23,
uh-huh,
because of the 300,000 cap, I can
yeah,
only claim 120.
yes,
So it doesn't matter whether accelerated or for the accelerated 30K. So because the previous slide is break into three years,
yes,
10,000 each. The
uh-huh,
120 will stay.
yes.
Okay.
There is two different rules, okay? One is the expenditure, one is the deduction. So for the expenditure is 300,000 over 3 years. So that means the company can have renovation expenses, right? Then we identify what are the qualifying expenditure. Then we will calculate, okay, for this 3 years period, I can only claim up to 300,000. I shouldn't use the word claim. I should have a qualifying expenditure of only 300,000. Okay, so company has 300,000 in year assessment 2023, but because of the cap of the 300,000 over a 3 years period, this is only 120,000. So that is the expenditure part, the 300K for the 3-year period. Okay, so that one, let me see. So that one is this part, this dollar part. Okay. So qualifying expenditure can 300,000 for every 3 years. Then the other question, there's two parts, right? One is qualifying expenditure, one is deduction. So after I determine already, for each year, I will deduct over 3 years period. Okay, this is the amount, this part is the amount that you're going to deduct against your what is that called? Deduct against the P&L to arrive at the adjusted profit. Okay, so you identify the expenditure. Expenditure can be capitalized or can be in a P&L. Okay, so identify the expenditure first. Then, after you identify, each year you will decide, okay, this year I have accelerated or not. No accelerated, 3 years. Have accelerated or not, 1 year. Have accelerated or not, don't have, 3 years. Okay, but ultimately, if let's say the thing is the YA year of assessment 2023 is 300,000, you can only claim 120,000. And whether or not the accelerated or not is in which year you are going to claim that 120,000. Are you going to claim it over a period of 3 years, or are you going to claim it in 1 year? So for year assessment 2023, because there is no accelerated option, you can only claim over 3 years. So there's two parts. Accelerated is for how you're going to claim. Okay, the 300,000 cap is for how much you can claim. You can qualify. Okay, how much you can qualify. You have a lot of expenditure, but you can only qualify only 300,000. Accelerated deduction is how you claim. How you claim, you want to claim over 1 year or 3 years. Does that answer your question?
Yes, thank you.
Thank you. Is there any other question? Okay, Jean, for that, Jean has a question. So for the 3-year block in the YA 2021 to 2023, assuming it skipped the YA 2021 claim, it can claim 30 years. Okay, so assuming that YA 2021 is the first year and the company hasn't claimed anything before, Okay, and it didn't claim YA 2021. So the 3-year block will be 2022 to 2024. Okay. Irrevocable for particular YA or subsequent YA. Sorry, I don't understand what does it mean by irrevocable for the particular or subsequent YA. Can you clarify the questions, Jean?
Yeah, you mentioned that once elected is irrevocable, right? This accelerated thing. So if I choose it for this YA and for next subsequent YA, do I have to stick to accelerated?
Okay, so the election is on a year-by-year basis. If let's say the company has elected for YA 2022, then it only apply for YA 2022.
Okay, so back to my example where the 3-year block is 2021, 2023, and this is not the first time it claimed, just that for YA 2021, it's for some reason didn't claim it. Then because the 3-year block is still within YA 2021 to 2023,
Yeah.
the third year it can claim 270K, right?
Yes.
Okay, thanks.
So because the first year there's nothing claimed, so that means during the 3-year period, maximum only 300. You can choose not to claim the earlier years, but the bad years you can choose to claim more. It's okay. Yeah, but then you cannot send a revised com to say that, oh, I forgot to claim a YA 2021. I now want to claim. Then you will affect your YA 2022 and 2023. So when YA 2021 is not claimed, then it cannot be claimed.
Okay, so then I subsequently have a question about the 180K that's not claimable under YA 2023. You mentioned it goes into balance sheet, right? So when it goes to balance sheet, does it mean that we can then claim it as depreciation?
Depreciation, yes, if let's say there is depreciation, the depreciation will always be in the profit and loss account. But so in the sense that you are claiming, but depreciation is not a deductible expenses. So we will add back the depreciation. Whatever you see for depreciation, amortization is not allowable. It's not an allowable deduction. We will add back. Then we will claim if let's say it qualify whatever expenditure it qualify under section 14 and we will claim section 14 and deduction. If let's say the expenditure qualify for deduction under section 19 capital allowance, then we'll claim for capital allowance. So once you see the tax com, see the P&L and you see there's depreciation, you will add back immediately the entire amount.
Okay, so in a way, the 180K spend is wasted in terms of deduction now.
Yes, it's wasted in that sense. It's not considered as qualifying for deduction or for claiming in future or not because it has exceeded the amount.
Okay, thanks.
Okay. Is there any other question? Okay, so let's recap the steps. The first steps in doing the section 14N deduction, in computing the section 14N deduction, we always determine whether it is qualifying R&R expenditure. So just now we have at slide sorry, which slide is that? 82, 1. Okay, slide 77. So the first step is talking about slide 77, where we determine which are the qualifying R&R expenditure. Okay, slide 77 provides a list of R&R expenditure. That's step 1. Okay, for step 2, we will determine the amount of qualifying R&R expenditure for a 3-year period. So 3-year period, 300,000 cap. So I identify qualifying, okay, then later I will cap my 3 years, 300,000. Okay, that is for the 120,000 cap, right? Just now we on the YA 2023 we have 120,000 cap. That is at slide 80 and 81. 79, 80, and 81. Okay, it's talking about the 300,000 cap for the period 3 years. Then for step 3, we will determine the R&R deduction for the year assessment. So the total deduction is equals to the allowable deduction from the previous year plus the deduction in the current year. Okay, so it is for the previous year as well as the current year. And for the qualifying expenditure for YA 2021 and 2022, the claim deduction can be over 1 year instead of 3 years if the company has opted to claim it over 1 year. Okay, so the total deduction is the allowable deduction from the previous year plus the deduction for the current year. So what does it mean? So for the purpose of this YA 2023, the total deduction is 90,000. The total deduction is equals to the deduction in the current year as well as the previous years. Because previous years we claim over a 3-year period. I didn't claim 150,000 in that year. So I apportion it over 3 years. So in year 2023, I can claim 50,000 and 40,000. That's what the slide is saying. Okay. So let's do a quiz to check your understanding. For this question, assume the company financial year end is December. Applicable period is YA 2021 to YA 2023. Year assessment 2021 is they have incurred a qualifying R&R expenditure of 150,000. In year assessment 2021, there's no accelerated deduction, so it's a 3-year deduction. In year 2021 means YA 2022, right? Total renovation cost is 880,000. Only 100,000 is qualifying. And in YA 2022, accelerated deduction is claimed. So compute the amount of section 14N deduction in YA 2022. Okay, I shall end the poll and share the results. Okay, the total amount of section 14N deduction for YA 2022 is actually 150,000. And how we compute the 150,000, you can check the the answers at slide 204. Okay, so we go to slide 204. Okay, just now the qualifying expenditure for YA 2021 is 150,000. Qualifying expenditure for YA 2022 is 100,000. Okay, first step, determine the qualifying expenditure for the 3-year period. All right, so because the qualifying expenditure has already been determined, so now we only determine the qualifying expenditure for the 3-year period. But for this case, there is only a 2-year, okay, the 3rd year, because we do not have the 3rd year information. Okay, so for YA 2021, there's no accelerated claim. So for YA 2021, it will be claimed over 50,000, 50,000, 50,000 over a period of 3 years. So 150,000 divided by 3, 50,000 in year assessment 2021, 50,000 in year assessment 2022, and 50,000 in year of assessment 2023. For YA 2022, there's a 100,000 qualifying R&R expenditure. Okay, so we can claim the full amount in the year itself. Okay, remember the total amount of qualifying R&R expenditure include the current year as well as the previous year. So it will include the YA 2021 50,000 as well as YA 2022 100,000. Okay. Go back to slide 84. Okay, so let's try another one. Same information as the previous question. Okay, just that in the YA, the new information is in the year 2022, that is YA 2023, renovation cost incurred is 30,000, that is non-qualifying, and 80,000, that is qualifying. Okay, I will launch the poll and you can key in your answers there. Okay, I will end the poll. Right, the answers for this is in slide 205. We'll go through slide 205. Okay, so just now we have computed YA 2021 and 2022. Now new information for YA 2023. Okay, we have to look at the cap of 300,000. So 2023 has a qualifying R&R expenditure of 80,000, but because of the 3 years period that is capped at 300,000, we have to reduce the YA 2023 qualifying expenditure to 50,000. So YA 2021 and 2022 is still the same as the previous example. They claim over 3 years, 50,000, 50,000, 50,000, and YA 2022 is 100,000. So for YA 2023 is a cap of the 50,000, right? So then we will have a cap of 50,000 here, divided by 3 years to get 66,000. Okay. Any questions? Okay, if not, we move back to slide 84. Okay, so again, how to do the tax computation adjustments in the tax form? We will need to look at first where is the renovation and refurbishment cost recorded. If it is recorded in the profit and loss account, our first step is to add back the entire amount of the qualifying expenditure. Okay, so then we will claim the deduction because the qualifying expenditure is a different amount from the deduction. So for this part, what am I saying is this. If let's say the in year assessment 2021, the company has incurred 150,000, and this 150,000 for some reason it is recorded in the profit and loss account. So in the profit and loss account, because this is not an allowable expenditure, I will add back 150,000. Okay, but because I can claim over 3 years, right? So for YA 2021, I can claim 50,000. So there's a two-step. First adjustment, remove whatever existing in the profit and loss. Second step, claim the deduction. If for some reason this qualifying R&R expenditure is not recorded in the P&L, it's recorded in the balance sheet. So what happens? Because in the first place, it cannot be deducted because this is not the correct amount, right? We wanted to remove from the P&L, but it is not in the P&L because it is recorded in the balance sheet. So there is no need to add back this amount because it's not in the P&L. You will just claim 50,000. Okay? So far so good with 14 and deduction. Any questions? Can give me some reaction because you are very quiet. I don't know whether you understand or not. Okay?
Okay.
Okay, good. Thank you. Okay, let's proceed to. We also have section 14B that provides for the statutory and regulatory expenses. So these are the expenses incurred to comply with the statutory law or any regulatory requirement. So if let's say the expenses is incurred to comply with the Income Tax Act, such as to prepare tax computation, so they pay the professionals to prepare tax computation, then the amount that they pay for the professionals is allowable for deduction. Okay, but if let's say the expenses is incurred to defend against charges of non-compliance with the statutory or regulatory requirement, then it is not allowable for deduction. So for example, there is some non-compliance and that the company wanted to appeal for certain deduction and things like that, then this amount, the amount incurred to pay to the professional fee is not allowable for deduction. Okay. There's also this slide on section 14B, statutory and regulatory expenses, some of the qualifying expenditure, and some of the examples are really self-explanatory. And same for this slide. So I will not be going through these two slides. Okay, for section 14ZF deduction, for expenditure incurred on immovable property while vacant. So usually for immovable property, what is the income that we will generate? Is rent, right? So if let's say the immovable property is vacant, so there's no rent income. So under section 14(1) deduction, it's not allowable because it's not incurred in the production of income. Okay, but I think from YA 2022, it is allowable because they recognize that they do have periods where property will be left vacant, but it's not without condition. So you can claim expenditure incurred on immovable property while it is vacant, because when it is vacant, there's no rental income. But you do incur expenditure like, still have to upkeep the property, like repair, insurance, maintenance, and upkeep of immovable property. Okay, these expenses can be deductible, if during this vacant period, if let's say the landlord has made an reasonable effort to find new tenant during the vacancy period, okay, in between the lease. That means it's not like the landlord didn't actually actively look for new tenants. So if the landlord is actively looking for new tenants and that this is just during a short break of time that the property is left vacant, it's allowable for deduction under section 14ZF. Okay, that is for YA 2022 onwards. Okay, the condition is there must be reasonable efforts made to find new tenant during the vacancy period in between leases. Other deduction expenses such as foreign exchange differences. This is one of the quite common expenses in profit and loss account, right? For expenditure, foreign exchange differences arising on revenue account is deductible and taxable, and foreign currency exchange differences arising on capital account is not deductible and not taxable. So again, we look at revenue and capital concept, and if it is arising on revenue, taxable, deductible. Is on capital, not deductible, not taxable. All right. And from YA 2020, there is some rules for some diminished rules for the application if let's say the bank account is not solely used for revenue purpose. So previously, bank account is on capital account. Okay, bank account is always on capital account, but if let's say the bank account is on designated bank account, then we will regard that particular bank account where the foreign currency transaction arises to be revenue. So if let's say I have bank account A, B, and C, and bank account A is used for those designated bank account that is solely used for receiving trade receipts or paying trade payables. That is the designated account. And if I have currency exchange differences arising from bank account A, I can claim a deduction if it is a loss, or I have to bring the gain to tax. Okay, so this is what the slides is talking about, and with effect from YA 20, if it is not a designated bank account, okay, it still can be allowable for deduction, but it's subject to certain rules. Okay. So for foreign exchange differences, usually they are recorded in the profit and loss account. So if they are recorded in the profit and loss account and the transaction is relating to exchange gain or loss arising on capital account, then we will have to make adjustments. And if it is a gain, we will have to deduct the gain, so that is I don't bring the gain to tax. And if it is a loss, I will have to add back. That means I don't allow the losses. Okay. So some of the common items for deduction will be compensation, damages, fines and penalty, insurance premium, and stop loss obsolescence. So for fines and penalties, only statutory fines and penalty are not deductible. So for example, parking fine or late compliance, didn't submit the income tax return on time, all these are statutory requirement, right? So they are statutory fines and penalties. These are not deductible. But if let's say my trade debtors, my trade payables, trade creditors fine me for not paying on time, okay, so they are fines, but they are not actually fines, they are actually interest, right? Because you are supposed to pay on time, but you are not paying on time, so they are charging the company an interest, or they can name it as fines. So these expenses are deductible for expense, are deductible. Okay, so we will allow deduction for this. So only statutory fines are not deductible. Okay, so provision, if let's say provision is specific provision, that means the versus the general provision. Specific provision is deductible, but general is not. Okay, general we have to add back the amount. Okay, so just now we talked about section 14 only. Okay, section 14 will tells you what is deductible, how much is deductible, right? What is deductible? We look at the section 14.1 general deduction formula. Expenses must wholly and exclusively incur in the production of income. Okay, then we talk about the section 14.5 to 8 on the medical expenses. They have a capping on how much is allowable. And we're talking about section 14N on qualifying R&R expenditure and how much is allowable for deduction. Okay, so then and other examples of expenditure like fines, non-compliant expenses, that is allowable deductible foreign exchange differences. Okay, so now section 15, it talks about what are the expenses that is not allowable for deduction. Okay, despite that it can be allowed under section 14, but what are not allowed under section 15 will not be allowable for deduction. Okay, so for example, domestic and private expenses. So if let's say the expenses is mainly private expenditure, like the director, they're traveling in and out, but the company is paying for the director traveling expenses coming into and going to the office. That's the company director's private expenditure to travel to the office and coming back, right? So these are not allowable for deduction if let's say there's a reimbursement. So it really like mirror image the section 14.1 requirement, right? So section 14.1 say it must be wholly and exclusively incurred in the production of the income, but private expenses is not incurred in the production of income, so they are not allowable for deduction. And for section 14.1b, it also mirrors the section 14.1, like Section 41 say it must be wholly and exclusively incurred in the acquiring the income. So Section 15(1)(b) say if the expenditure is not wholly and exclusively incurred in acquiring the income, it's not allowable for deduction. So it's like if let's say the expenditure is for dual purpose, then it's not allowable for deduction. Okay. We have capital expenditure and capital loss. So capital expenditure and capital loss are not allowable for deduction. Capital employed for improvement is also not allowed for deduction. Okay. We have rent costs. Rent costs that is not incurred for the purpose of producing the income is not allowable for deduction. And income tax, any income tax that is paid on the income in Singapore or outside Singapore is also not allowable for deduction. Note that this is income tax, not any other tax, but income tax is not allowable. Okay, so for motor vehicles expenditure, it's covered under Section 15(1)(k). There are certain specific rules about motor vehicles because we have so many types of motor vehicles, right? So we have S-plated car that have a car number plate that's starting with S. We have lorries, you know, we have vans that start with V and things like that. So we want to differentiate what is called private motor car expenses, what is not. So generally, if let's say it's relating to S-plated car, it is not deductible, notwithstanding that if they are incurred for the company's business. So for example, if let's say employee he drive his own car to help the company to do some delivery, okay, so these are, he drive his own car is an S-plated car. So the employee will claim petrol, claim parking from the company. Then the company record this as expenses, but these expenses are not allowable for deduction because they are relating to private cars. Okay, so reimbursement of private car expenses incurred by employees is not allowable for deduction. So similarly, petrol maintenance cost of private cars is also not allowable for deduction. And if let's say the company have a motor vehicle van, okay, this van is used for the daily delivery of the goods and things like that. So they are incurred for the purpose of deriving the income. So all these expenses, the petrol, maintenance of this commercial van can be allowable for deduction. Okay. So exceptions to Section 15(1)(k). Just now in 15(1)(k), we talk about what is not deductible. Okay, so these exceptions means that what is deductible. Okay, so not all motor vehicle expenses is not deductible. Taxi fares are deductible. Okay, motor vehicle expenses incurred for motor car registered outside Singapore, used exclusively outside Singapore is deductible. Bus fare, public transport, Q-plated car registered before 1st April 1988, or cars that is used for instructional driving instructional purpose are allowable for deduction. Okay, so take note that this slide 98 is expenditure that is allowable for deduction. Okay, slide 97 is expenditure that is not allowable for deduction. Okay. Okay, then tax treatment of private motor vehicles. We have listed down what are the types of expenditure, like private S-plated car, Q-plated car that is registered after 1st April is not allowable for deduction, and foreign registered car used exclusively outside Singapore is deductible. And reimbursement of employees' S-plated car is not deductible. Transport allowance to staff is deductible as part of the cost because the company can provide allowance to the employee, but the employee can choose to take taxi, public transport, or drive his own car. So the company has no visibility over how the employee is going to incur that particular allowance, right? Use up the particular allowance, but so this allowance will be form part of the staff cost and it is allowable for deduction. Okay, there are examples on what is allowable deductible expenses. So these are the allowable deductible expenses. You can also find a comprehensive list in the IRAS website. And what are non-deductible expenses? So just now I mentioned about amortization, depreciation. Okay, they are not deductible for deduction, so we will add back. If let's say you have incurred depreciation for certain qualifying or non-qualifying, doesn't matter, just add back the depreciation amortization. Okay, we also have statutory, these are statutory fines and penalties, and goodwill payment because of capital in nature. Then any motor vehicle expenses that are of private nature, domestic, they are not deductible, as plated car are all not deductible, we have to add back. So for this particular list, in 100, slide 100, if the expenditure in slide 100 is in a profit and loss account, okay, they are deductible expenses, no adjustments, because we allow them to claim, right? So it has already been computed in the profit and loss, so no adjustments. Okay, but in slide 101, there are non-deductible expenses, and these non-deductible expenses, if they are included in the profit and loss account, so what do? We add back, because they are not allowable for deduction. So I don't allow, I add back the amount. Then what does it mean? It increased my chargeable income. Okay. Slide, let me pause and see. Fines, penalty relating to statutory fine only, does it include late payment of utility bill? Okay, late payment of utility bill, they are not. Okay, so fines and penalty are those offenses, you know. Late payment of utility bill is more like, you know, the company, more of the part of the business's expenses, not so much of non-compliance or things like that. Okay. Can you repeat the diminished rule on the foreign exchange differences? Okay, foreign exchange. Okay, the diminished rules, there is certain guidelines on what are the amount. If there's certain amount that let me go to this list. Okay, so generally, bank accounts are considered as capital. Why? Because bank account, you do use the bank account to purchase assets. You do use bank accounts to buy, to receive capital receipts. Okay, you do use bank accounts to make trade payments, and you use bank account to receive trade receipts. So if all these are lumped together in one bank account, that is, they have capital and revenue in nature. So that is why for bank account, usually it will be regarded as capital in nature. So any expenditure any foreign exchange differences arising from the bank account will be regarded as capital in nature. Okay, so there is a concessionary treatment. Certain companies, they like to organize their certain bank accounts into designated bank accounts, and that is only for receiving trade receivables and making trade payable payments. And if these are the designated bank account, the exchange differences arising from this designated bank account is regarded as revenue in nature. And if it is a gain, it will be taxable. If it is a loss, it will be deductible. Okay, with effect from YA 2020, okay, this tax treatment, that means I can still have the gains arising from the bank account to be deductible and taxable, even if the bank account is not solely maintained for revenue purpose. That means if let's say the bank is not a designated bank account, okay, I still allow for deduction. Okay, but in order to qualify for deduction, you have to follow the de minimis limit. And the de minimis limit actually spells out about I think it's the quantum of the amount in the bank account. So there is certain guidelines on how much you will consider this non-designated account that qualify, that met the de minimis rule, and the the foreign exchange differences on this non-designated bank account that qualifies for de minimis limit can be allowable for deduction. Okay. Wen Fang. Okay,
Yeah, okay, thanks.
okay. Wong Chia Kiong. Donations are entitled to 2.5 times of the deduction. Yes, donations, qualifying donations, if donations that is made to approved IPC, the amount can qualify for 2.5 times. So if let's say a donation is in the P&L, we will list out all the donations first, because we do not know this donation is qualifying or non-qualifying. But once we found that they are qualifying, we will multiply it by 2.5 times and deduct it against the statutory income. Okay. The rental fee tax deductible is stated. If the company rents the car for employee use, is the rental fee tax deductible? No, it is an S-plated car, so rental motor vehicle expenses not deductible in relation to S-plated car. Even if the rental of that car for the employee use is for carrying out the company business activity. So as long as S-plated car is all not deductible. Okay. Yang Ning, okay? Okay, thank you. Give me a moment. I need to get some water. We can do a quiz, a short quiz on this to test your understanding on what is deductible and what is not deductible. Okay, whether legal fee for incorporation, is it deductible? Reimbursement to marketing director for using its own car for businesses, taxi, MRT expenses for staff to attend meetings, and donation to Red Cross Singapore. Okay, the question is whether it is deductible under section 14 and disallowable under section 15. Okay, let's end the poll. Oops. Okay, for legal fee for incorporation, they are not deductible. It's prohibited under section 15(1)(c). Reimbursement to managing director for using his own car is not deductible. Usually, individual who own the car is usually expatriate car. So reimbursement to managing director for using his own car as private expenses is not allowable for deduction. And MRT and taxi expenses for staff attending meetings, so it is for the business and its public transport is deductible. Donations to Red Cross, okay, deductible, not deductible, okay. The Red Cross is the IPC, is deductible, but it's not deductible under section 14(1), okay, because it's not incurred in the production of the income. You give donations, it is not incurred to derive any income, right? So it's not allowable for deduction under it's not provided for deduction under section 14(1), and it is deductible under other sections. Then we will look at whether the charity that you are donating to or the funds that you are donating to, is it approved public institution of public character. Okay, then it will have 2.5 times of allowable expenses on the amount that you have incurred. Okay, so for the purpose of this question, if it's deductible under section 14(1), okay, it is not deductible under section 14(1). Okay. Okay, I think we are all good for today. We have covered the income as well as the expenditure. We cover about the tax computation format. So you can go through the slides again to identify what are the deductible and non-deductible expenses, and go through the section 14(n) deductions, computation, medical expenses computation. So there is case study for you. While you're going through the notes and things like that, you can also take a look at the case study 1, where they have some of the expenses, whether it is deductible or not deductible expenses, and some section 14(n) computation. You can attempt case study 1 to test your understanding. Okay, so the study guide is I've gone through the study guide. It's actually very helpful to give you a good overall understanding. And the slides we have actually consolidated as much as possible to let you all have the clear understanding, and also to facilitate the course conducting the course. So if any point of the slides that you are not sure, please go back to look at the study guide for more questions. There is also questions in the study guide that will help you in your understanding. So it will be good if you can attempt those questions in the study guide, and also do the questions in the case study to help you with your understanding. Can you all hear me?
Yes.
Okay, good. So is there any other questions that you have for today's session? Do you have the case study question and answers? Do you have?
Where do we find it? Is it in the hard copy tutorial notes or?
Yeah, the tutorial notes, is it the slide form? It's not a slide form. Let me see. I share the copy. You hold on, let me find my copy.
I think we have the question, but no without the answer.
Don't have the answers.
Yeah.
You want to try to attempt it? Study question 1. Okay, do you have this?
No.
Don't have, huh?
I have
Later,
it. It
will they
comes
have a
with
copy of this? Huh?
it comes with the tutorial notes. I have it.
Yeah, it's
Okay.
actually in the CPA portal, the online learning.
Do you want to go through this tutorial together, or you want to try attempt it yourself?
If you have time, maybe you can run through, then we can revise again.
Okay, can. So let's go for one quick one. Because give me a moment. I open up. Okay, so there's only for part 1, it will be question 1. There's 2 parts to it. So for company A has a paid up capital of, you're looking at you can see the screen, right? The case study notes.
Yes.
Okay, good. Okay, so company A has a paid up capital of $2. It invested in a few penny stocks counter in Singapore Exchange using an bank overdraft and proceeds from the earlier deposits. So company A made 10 or more shares disposal each month. An average holding period of each block of shares purchased and sold between 1 to 3 months. So buying and selling of shares were carried out by its sole director, who is a trader in shares himself. Company A made a gain of 100,000 from the various disposal. So discuss the taxability of the disposal gain of 100,000. So, can you tell me how should we approach this question?
He's in the business of trading or investing. So this is a
Okay.
trade income.
It is a trade income. Okay, so we will not be able to see just one line. Okay, so just now we have touched on badges of trade, right? So we want to see whether it is trading or not. We will look at the badges of trade. Correct? So first of all, to determine whether the taxability of the disposal gain, we will need to first consider whether the gain is capital or revenue in nature. Correct? So
Yes.
if it is capital, it is not deductible, not taxable. If it is revenue in nature, it is taxable. Okay, so how do I determine whether it is a trade or not? We use badges of trade. For those who know, we contribute, okay? So that we make we can learn together. Okay, so for badges of trade, we have in our slides we have 10 badges of trade. So first is about the subject matter of realization, and what is it that the company is buying? It has a $2 payout capital, and is investing with a few penny stocks. So the company is buying penny stocks, right? So penny stocks, all these are easily available from the Singapore Stocks Exchange, is easily tradable. And whether it is buying or selling for resale or long-term investments by itself, we are unable to see, but we can look at other things. We'll look at other factors. Okay, we look at the length of ownership. So how long did they hold the shares?
1 to 3 months.
Yeah, 1 to 3 months. So 1 to 3 months can suggest that the company is trading. It's very short, right? Sometimes people buy for dividends holding. They will usually dividends holding will take how long? When the company declare the profit, then they will have the dividends, right? So 1 to 3 months maybe is a quick sale, right? So how many did they buy? What is the similar frequency of the transaction?
Is it the 10 and each month? 10 or
Yes.
more? Yeah.
Yes, so it by similar nature of things, right? Penny stocks, right? 10 or more disposal. They also buy about. It so it actually make about from the disposal. It actually have 10 or more disposal, but they have invest in the stocks. So how do they finance this disposal? Sorry, how do they finance this share acquisition? Overdraft and
The proceeds from the disposal.
yeah. So if it is an overdraft and proceeds from the earlier disposal, it also suggests kind of trading, right? So because overdraft first is the company payout capital is only $2. So the company does not have the financial means to
hold the share.
To hold for a long term, right? So it doesn't have a financial means, and also they utilize it from the proceeds of the earlier disposal. All right. So there is engaging in high frequency, or engaging in similar transaction also. Okay. And what is the circumstances responsible for the sale?
He's a trader.
Yes, he's a trader. And it could also be because he could not hold the shares for long term because they are using on bank overdrafts, right? He may not have enough money to hold, and also he's a trader. He will buy and sell the shares when appropriate, right? So all these points to what? The gain on disposal, is it likely to be revenue or capital in nature?
Revenue.
Okay, it points to be revenue in nature, and is it taxable?
Yes.
Okay, so this is how you approach when you want to see whether is this gain taxable or not. Okay, you will first look at the badges of you will first look at capital revenue divide, capital not taxable, revenue taxable. So what can I say about this? Whether it is trade or non-trade, look at badges of trade. Okay, and there's a few badges of trade for us to take a look. And based on just now what we have covered, we didn't use the 10 badges of trade because based on the limited information here, right? We use as much as possible. Holding period is one of them. Okay, and frequency of transactions, financial capability to hold the financial assets, the realization, subject matter, and circumstances to dispose the sale. Okay, all these are good badges of trade for us to determine whether or not the disposal is the gains is taxable or not. Okay.
Sorry, Rebecca, I'm not sure whether my question is relevant, but if this is a sole proprietorship, then it becomes like personal trading, then it's capital gain in nature.
So proprietor also have the capital and revenue divide. So if it is trading, right, it's most likely to be having this taxable, right, because it's still trading.
Okay.
Any other questions for this? Okay, so we look at the badges of trade. We all know the badges of trade is at is at slide 44 to 46. Okay, so we use these badges of trade to apply in this kind of situation. Okay, and for part 2, company B, real estate company, incurred the following expenses in YA 2023. Okay, so they have give refreshments for client. Is it deductible?
Yes.
Yes.
Yes. Okay, so why is it deductible?
It's something to do with his business because it to his clients.
Okay, so it's under the general deduction formula. It is incurred in the production of the income. Okay, and advertisement for property launches.
Yes.
Yes.
Yes, it's deductible. Why is it deductible?
Because it's an expense for the producing of the income.
Yes, so it's a revenue expenses in the production of the income. Okay, how about entrance fee for corporate membership with fitness club?
No, it's one time.
Okay, reason why it is not deductible?
Capital. One-time fee is capital in nature.
Okay, so it's capital in nature. It's all for once for all in deriving the enduring benefits, right? So if it is, how about if it is the subscription fee?
Deductible.
Deductible. Okay, good. Okay, general provision for repair and maintenance.
No, no deductible.
For
Okay,
his own
what?
office?
Okay, assuming it's for his own office, is it deductible?
Should be, right?
No.
No,
No.
Why is it not deductible?
because
This
it's general provision.
Yes, it is a general provision. So is it incurred?
No,
No.
not no.
General deduction formula, it must be incurred in the production of income. Okay, so general provision means you provide the amount but you have not incurred, so it is not allowable for deduction. Okay,
Okay.
interest incurred on loan taken to purchase office premises.
Yes, deductible.
Yes.
Okay, is deductible under section 14(1)(a). Okay, this is used to obtain to purchase the office premises. Okay, how about cost fee to attend external service excellence course? Is that
Yes.
training cost? Okay, for staff, so it's deductible. And the reason?
Because it's a part of benefit to the staff. It's a
Okay,
yeah.
It's incurred for the production of income.
incurred in the production of income. Okay, so we always look at the general deduction formula, whether general deduction formula allow for such deduction. Okay, then later we'll look at whether it is disallowed under section 15. Okay,
Okay.
and so now company B, let's proceed to B. Company B also incurred the following expenditure for YA 2023. So laser printer. Okay, sorry. Laser printer, renovation, refurbishment work, designer fee, construct storeroom, carpet, general electrician installation, office table and chair. So advise whether the company B for each of the item qualify for capital allowance or another form of deduction and compute the CA and tax deductible deduction claimable for YA 2023. Okay, so for laser printer, is it qualifying for, okay, so we narrow down to two, capital allowance or section 14N deduction. So is laser printer qualifying for capital allowance or section 14N deduction?
Yes, capital allowance.
Capital allowance. Laser printer is usually, okay, capital allowance. How about renovation and refurbishment work? We have designer fee. Is it allowable? We look at Which
No.
slide are we looking at now? We have a list
Uh,
of qualifying and non-qualifying, right? So we look at slide 77 and 78.
No.
Okay, so whether it's qualifying under slide 77 or non-qualifying under slide 78. So designer fee, is it qualifying or not?
No.
Not qualifying expenditure under section 14N. How about construct a storeroom which require approval from the Commissioner of Building Control?
No.
also no.
No, okay. And how about carpet?
Carpet
Yes.
CA.
Possible.
Carpet is a capital allowance. So how about general electrical installation, fixed partition, flooring, false ceiling, and cornices?
Yes.
Yes.
Capital.
Allowable under section
14.
14N. Okay. So section 14N, these are qualifying expenditure, not deduction. Okay. So how about office tables and chairs that cost less than $5,000
CA.
each? Capital allowance.
Yes.
Okay, so we will talk more about capital allowance in our next session. So this session we talk about the taxability of income as well as deductibility of expenses. Okay, you need to know the format. For those who are not familiar with tax computation, you need to know the format of the trading company tax computation, so that you can organize your deduction and deductibility and taxability of the income expenses. Okay.
Rebecca, can I ask, when you answer this kind of question like question B, right? Do you still need to put the section 14, all these things? Or we can just say there is a actually deductible under R&R.
Okay, so here the question asks whether it qualify for capital allowance and or other form. So for item by item, you it's good that you know, because anyway there's only a few section, is section 14N or section 19, right? For capital allowance.
Yes.
Yeah, so it's 14N or 19A. Okay.
So we just call like the general, no need like the section for 14N is which section, all these things.
No need.
Okay.
Okay, so you can, okay, so for refurbishment, you say not allowable or not allowable for example, designer fee, not qualifying for section 14N deduction or CA, because the question asks, is it allowable? If it is not allowable under section 14N, is it allowable under section 19 for CA?
Okay.
Okay, so you have to answer two. So you have to take note what is the question asking. Okay.
Rebecca, I have a question on, the income tax and the GST Act, right? I know that it's not compulsory to bring it to the exam, but would you recommend us to actually still print it and bring it along?
I mean, you can bring, but whether you have time to refer or not.
Okay, because I went to actually inquire on the one that we say we can purchase from. It's actually pretty expensive.
Oh, okay. But there is a income tax legislation in online.
Yeah.
Yeah.
Okay.
So yeah, so it's good that you go through and read up the wording in the legis, to have a sensing of how legis is worded. Legislation, the income tax legislation is worded. Yeah.
Okay.
So it's good that in terms of all this computation, you must really know what is deductible, what is not deductible. Then you are able to do the computation, right?
Okay, thank you.
Okay. Any other questions?
Yes, Rebecca, can I check? Would you run through with us what is like give us some tips? What is the exam tested or not tested? Like those supplementary slides they given.
Okay, so all under the study guide is actually examiner. that there's possibility that questions from the study guide can come out. And because the slides is one part of the study guide, but we consolidate all the very information in a very concise manner. Okay, so I do not know what are the questions that will be coming up or not. Probably it's good that you take a look at the study guide. There's a lot of examples in there, and there is a lot of questions in there for you to practice. So whatever is covered in the slides is also very important. Okay?
Okay.
Because these are the day-to-day that you will do the computation. These are mostly all the information that you require to do a basic tax computation. Okay. Any other questions to the earlier slides? By the way, are you able to hear me? Because
Yep.
I feel that you're a bit soft also. Don't
Yeah,
know
we
whether
can
you
hear
hit the
you.
mic or okay, good.
And it's really helpful, by the way, Rebecca. Thank you so much.
Okay, thank you. So if you have no questions, then I hope that you all can take some time to look at case studies as well as go through the questions in the study guide. Okay, and the examples. It really helps you in your understanding. Then if you can have the time to read up on the next week slides, it will also be good because there is quite intensive for next week. We have capital allowances. Then we have how the receipts, whether the receipts will be foreign source or Singapore source, it's quite heavy for next week as well. And I hope that we have more time and next week we can go through the case study for question 2 as well. Okay?
Okay.
Okay, thank you very much, Rebecca.
Thank you.
Thank you.
Have a nice weekend. Bye.
Thank you. You too.
Bye.
Bye.
Bye-bye.
Bye bye. Thank